I am Oscar Semweyamsoke, and I'm your host today. In a few minutes, I hope we shall begin in earnest. In the meantime, sit at a table where you can talk with someone. Or invite someone to your table so that you can talk to them. The theme is reducing the cost of credit in Uganda, the case for public investment in banking. So that's a good topic to talk about. We have a hashtag UG cost of credit, and then hashtag NDPF. We also have, we'll have live streaming on NBS, and then on NPA, National Planning Authority, streaming channel on YouTube. Good afternoon, ladies and gentlemen. Once again, I'd like to welcome you to the 11th National Development Policy Forum. We are going to make a start, and I'd like to invite you to stand up for the national and East African anthems. Thank you. Someone came and whispered to me and said, they are not going to sit down unless you invite them to sit down. Such power a moderator has. Thank you very much. I'd now like to invite the chairperson of the National Planning Authority to come and give welcoming remarks. Let's have a hand clap to welcome Professor Pamela Kasabiti Mbabazi.
Thank you very much, moderator. Now, we do have a culture at the National Planning Authority that I'm going to beg your indulgence about, that we begin with a word of prayer to commit this very important conversation to the Almighty. And I'll ask my brother here to lead us in a word of prayer. Please come and help us. Thank you.
Let's humble ourselves for prayer. Father, Lord, we thank you today. We thank you for the gift of life. We thank you for bringing us here to discuss matters that are so important to the nation of Uganda. We pray that you allow us, give us the wisdom and the courage to discuss without fear for the beautiful country that we live in. Thank you.
Thank you. Let's give him a round of applause unto the Almighty. Thank you very much. All distinguished guests, Ugandans here and online, ladies and gentlemen, on behalf of the board, management and staff of the National Planning Authority, and on my own behalf, I would like to welcome you all to the 11th National Development Partners Forum and take this opportunity to thank you most graciously for honoring our invitation. Thank you for coming. I think it's very, very important that as a country, we have such moments of dialogue and debate, especially on very pertinent issues that affect our well-being, like the cost of credit. So I don't take this lightly. For those of you who are here physically and those of you online, thank you for sparing time. I think we're going to have a very engaging discussion, debate. We want to listen, we want to chat, we want to converse. We have to get it right. Ladies and gentlemen, as you already probably know, Uganda has chosen an inclusive private sector-led and export-oriented policy to drive development. And as a consequence, strengthening the private sector to drive inclusive growth, as well as sustainable wealth and job creation, have been formulated as one of the 5 objectives of the National Development Plan 3, and private sector development as one of the 20 NDP3 national programs. The overall objective of the private sector development program is to increase competitiveness of the private sector to drive inclusive and low emission growth in line with Uganda's green growth strategy. The challenges that inhibit the growth of Uganda's private sector include, among others, the high cost of doing business, absence of a strong supporting environment for the local entrepreneur, weak enforcement of standards and the proliferation of counterfeits on the market, but also limited private sector investment in key growth, among others. The high cost of doing business, ladies and gentlemen, is attributed to a number of factors, including high interest rate, low productivity of firms, and inadequate access to land for investment due to high acquisition costs. In spite of the reforms made in the financial sector and the historically low central bank rate, which is around 6.5%, commercial interest rates in Uganda remain high, ranging between 18 to 23%. The high interest rates can be partly attributed to low competition in the banking sector. We have 3 large banks, Stanbic, Stanchart, and ABSA, controlling approximately 40% of the credit market. Limited options of investment financing, high bank operational costs, high risk involved in the key investment activities, high levels of business informality, and weak corporate governance. The high interest rates, combined with comparatively low rates on customer deposits, increases profitability of commercial banking, but limits growth of savings, which forms the foundation for a growing commercial banking sector. In fact, ladies and gentlemen, Uganda has one of the highest bank lending deposit spread within the region. Now, due to the high interest rates, there is a slow growth of the private sector credit, as well as high bank non-performing loans to gross loans ratio of about 10%. Moreover, as already said, there are the 3 largest commercial banks control about 40% of the credit market. So, ladies and gentlemen, this, of course, has been even gravely impacted, or rather been impacted by COVID-19 and the Russian-Ukraine war or conflict on global trade, which has brought to the fore the need to tackle this long-standing issue of high interest rates, which has constrained access to patient capital by the private sector, which is a key pillar of our import substitution and export promotion drive. It is within this context in mind that the National Planning Authority commissioned 3 studies to guide decision-making and policy recommendations on the issue of lowering the cost of credit. Now, these studies included the effective setup and operations of public commercial banking in Uganda, financial and economic analysis for government investment in public commercial banking, and comprehensive analysis of the performance of Uganda's public banking sector. The findings and recommendations from these studies have been synthesized. They've been packaged into a thematic paper on reducing the cost of credit, the case for public banking, which we're here today to present to you and get your feedback, your input, and ensure that we move together as one country as one nation to deal with this issue. I therefore want to invite you to study these recommendations contained in this paper very closely and make your input before we come up with a finalized document that will be presented to Cabinet for consideration. So this is your opportunity, ladies and gentlemen, to make your voice be heard. And I urge you to make use of it. We will take all comments, criticisms, questions, and contributions to ensure that we get it right. But as I conclude, I really want to say thank you in a special way to our very true partners in progress, the United Nations Development Program. And Madame Elsie is right here, for accepting to partner with us on this particular activity and in providing some of the funding for conducting the studies that have informed the drafting of this paper that we're presenting here today. NPA looks forward to your continued partnership in our quest to increase public understanding and participation in economic and social policy debate. And I really want to thank each and every one of you once again and to invite you to exercise your intellectual honesty and tell us exactly what you think about our findings. Once again, thank you for honoring our invitation, and I wish us all fruitful deliberations for God and my country. Thank you.
Thank you, Professor Mbabazi. She really deserves a bigger hand clap. Highlighted the challenges and the direction in which the discussion should head. I would now like to invite the UNDP resident representative, the United Nations Development Program, UNDP, resident representative, Ms. Elsie Atafua.
Thank you very much. I was just telling Pamela that there's a bit of a surge in COVID now, so maybe we should spray this so we can, do we have any of the sanitizers around? All right, let's use that. Because we get beginning to see some surge. We just came from a meeting with our sister agencies and they're telling us, and I have 2 colleagues, staff of mine already down. So, no, I'm just spraying this. Professor Pamela Mbabazi, Chairperson, National Planning Authority, Dr. Joseph Muvawala, Executive Director, National Planning Authority, and all the board members and staff of NPA, representatives of ministries, departments, and agencies present, the private sector, the members of the diplomatic corps and the development partner community, colleagues from the United Nations system, academia, civil society. Let me simply say, ladies and gentlemen, and all protocols observed. Good afternoon to you all. I didn't hear. Good afternoon. On behalf of the United Nations Development Program, UNDP, and indeed our wider United Nations family in Uganda, I'm delighted to join you all in this 11th National Development Policy Forum on reducing the cost of credit in Uganda, a case for public investment in banking. Friends, in March this year, the Ministry of Finance, Planning and Economic Development, together with UNDP and the World Bank, held a validation meeting for the public investment financing strategy. In the meeting, different stakeholders discussed sustainable, innovative, and affordable development financing options for the implementation of the 3rd National Development Plan from the public sector perspective. Today's dialogue builds on this discussion with a focus on cost of credit for the implementation of NDP3 from the private sector perspective. As you know, small and medium-scale enterprises account for over 90% of private sector firms in Uganda. They are the most significant contributors to employment and generate most jobs in the country. The SMEs were also hardest hit by COVID, as we know. Therefore, assessing affordable credit is crucial for the private sector development, economic resilience, and really recovering from COVID. So why is it important, Madam Chair and friends, why is it important to dialogue on reducing the cost of credit in Uganda? Why? The NDP3 identifies limited access to and high cost of capital as one of the top 5 development challenges. This is limiting attainment of NDP3 targets in the key growth sectors of agriculture, manufacturing, and tourism. The high cost of credit and related financial exclusion has for long been a major policy concern amongst policymakers, parliamentarians, private sector, civil society, and name it. Uganda has undertaken financial sector reforms, including liberalization to increase competition and reduce the cost of credit. While Uganda's banking sector is more open and dynamic, the critical issues of credit, cost of credit, and range of financial production remains a challenge. Lending interest rates in Uganda are relatively high, and I think Professor talked about it, for a variety of reasons, including high overhead costs, high interest rates on government bonds, and high levels of bank profits. I hope I'm politically correct. This makes it difficult for SMEs to borrow from commercial banks for the productive investment that is required to achieve high rates of jobs and job creation and economic growth. Today's dialogue is timely and addresses a very important development issue for Uganda's transformation and sustainable development. Madam Chairperson, colleagues and friends, how does the cost of credit in Uganda compare with other countries? And I want to spend a bit of time to benchmark. And what does this mean for Uganda's competitiveness? At an average of 20 to 22% per annum, Uganda's lending rates remain one of the highest in Africa. According to the World Bank data, cost of credit is more than double the cost of credit observed in the recent years in at least 19 African countries, such as Botswana, Cote d'Ivoire, Ethiopia, Mauritius, Namibia, Senegal, South Africa, and Zambia, amongst others. It is interesting to note that the lending rates in these countries are less than 10%. And this also includes countries such as Togo, Benin, Comoros, Eswatini, Lesotho, etc. Bringing the story home, closer home, as background study for this dialogue highlights, the East Africa average is only 14 to 16%. It is therefore important to know that lower interest rates in neighboring countries will make Uganda's private sector less competitive, even in its home market. With such a high interest rate, Uganda will certainly be less competitive in leveraging the Africa Free Trade Continental Area Agreement, for example, to boost its exports and accelerate economic growth. The high cost is one of the leading causes of the high mortality rate of new businesses in Uganda. Hence, the government and commercial banks need to urgently find innovative ways to bring down interest rates to make us more competitive. Madam Chair, colleagues and friends, what options do we have to address the high cost of credit in Uganda? What are some of the options? So let me just focus very briefly now on 5 points that I want us to reflect on. 1, policy integration at national and regional level. Inclusive financing calls for integrated solutions involving both the financial and non-financial sector. We need to consider the following: reorient our monetary and fiscal policies to drive industrial development, trade, and investment, as well as accelerating monetary and fiscal integration with a view to enabling industry, trade, and investment. So point 1 is policy integration at national and regional levels. The second point is on appropriate de-risking mechanisms. Risk is one of the biggest drivers of the high cost of credit. We cannot run away from this reality. We therefore have to deliberately develop diverse mechanisms for de-risking investments. And there are a couple of things we can really do. We need to consider the following: public credit guarantee schemes to unlock commercial and other financing windows. Insurance schemes also for primary growth sectors. So that's the second point. The third is on supply of credit. The supply of credit needs to be significantly increased. This calls for measures to promote, for example, external resources to further capitalize the Uganda Development Bank and other financial institutions, increase national private savings. The savings from our own SACCOs could be pooled under a special vehicle to provide appropriate short and long-term financing solutions for local businesses. And then reducing government borrowing from commercial banks. This is critical to avoid the crowding out of the private sector credit. 4, leveraging the digital economy. And I think if we know COVID has been terrible, but if there's one thing that COVID has helped us with, is to look at really the space of digitalization. And there are two sides to harnessing digitalization of financial services. Commercial banks should improve digital services. Government needs to improve the database of SMEs and strengthen the Credit Reference Bureau. And finally, and I see a lot of young, enthusiastic young men and women here, targeting financing for youth and women in niche value chains. So we should be looking at grant financing to de-risk startups, innovation and incubation support, for example. Madam Chairperson, colleagues and friends, let me just spend just a short moment to reflect on some of the things we are doing as UNDP to support this subject that is under discussion today. And what is it telling us? What is it telling us from a practice point of view? In this context, allow me to share some of these initiatives, like I said, in line with our own country program that has been agreed with the government of Uganda. First of all, UNDP established a rapid financing facility, harnessing nature and digital technology to stimulate the recovery and building a resilient tourism sector in Uganda. We put up about $2 million and supported the Ministry of Tourism, Wildlife and Antiquities, Uganda Tourism Board, Uganda Wildlife Authority, and others to really ensure that we harness nature, we promote digital technology, and we can stimulate the recovery. And I think this type of financing, which was flexible, including for the private sector, has been very important. And I think when you see some of the traction we are beginning to see in the tourism sector, it's because we had to put in some really grant financing to give it that boost. The second thing we have been doing also in line of the subject matter is the establishment or creation of what we are calling a Youth for Business, Innovation and Entrepreneurship Facility. And in 2020, we were blessed during the occasion of the celebration of the International Youth Day at the State House that His Excellency, the President of Uganda, H.E. Yoweri Museveni, launched this Youth for Business facility, which we partnered with Stanbic Bank and others. Now, through this facility, we have provided about already $4 million to young businesses, grant financing up to about $40,000 in the sectors such as agriculture, agribusiness, tourism, mining, renewable energy, manufacturing, creative arts, ICTs, construction, and health, amongst others. The third thing we have been supporting is what we're calling an SME for Trade initiative to unlock the potential of Uganda in the Africa Free Trade Continental area. We believe it's a game changer for the continent, and Africa is only trading 16.6% amongst itself, and we need to be trading. This is where our prosperity and our wealth will come from. I mean, coming from a place like Ghana, and in West Africa in general, I mean, why don't we see Uganda milk in the shelters? And yet we are importing from other spaces other than Africa. So we are implementing this trading beyond EAC and COMESA, which offers such great potential. Amongst the objectives of the project is establishment of a trade financing facility targeting women and youth-owned SMEs. Under this initiative, UNDP is partnering with all the major business membership organizations to strengthen competitiveness and export readiness for AFCFTA. These include the Uganda Manufacturers Association, UMA, the Private Sector Foundation of Uganda, PSFU, Uganda Chamber of Commerce and Industry, and I could see Madam Olive smiling here, Federation of Small and medium enterprises, Uganda small-scale industries, USIA, and many others. And we're working with the Ministry of Trade, NPA, APSA, UBA, Centenary Bank, Afrexim Bank, and others to provide support. Now, I'm giving this example because I want to focus, and I'm going to be wrapping up very soon. What are we learning? What is it telling us? What is it telling us about the cost of credit? What we are beginning to see in a couple of points. First, catalytic financing through grants is facilitating and piloting and scaling up of commercially viable, impact-driven youth and women-led initiatives and enterprises. Second, grant support for startups with a focus on innovation and scaling up has demonstrated potential to unlock long-term financing as well as ease access to niche regional markets. For example, one of our youth grantees, Ecoplastil, that's recycles plastic waste for construction materials, is being considered for equity by a development bank. The grantee has already secured supply to over 15,000 recycled plastic towels in Ghana and also others in Kenya. So what am I saying? The fact that we sowed a seed and this company, now others are looking at this and potentially this could become one of the big companies in Uganda one day. Third, through grant support to a fintech startup, for example, Akelo Banker, over 60,000 farmers in Sebei sub-region can access affordable credit facility through digital channels. In other words, the cost of credit, when we address it, is not only about the money, it's also about creating job opportunities. And here we are talking about 60,000 farmers. Our grant support to coffee roasters is opening opportunities for farmers to supply more coffee to value chain SMEs. And Diro Coffee, for instance, has tripled the amount of coffee they are buying from women farmers of Arabica Coffee in Bududu district. Inspire Africa and Volcano Coffee are better equipped to roast larger quantities of coffee and develop other products while building capacity for export. In other words, our investment here again is beginning to show results and impact. UNDP's de-risking has enabled the startups to leverage other financing opportunities from banks and development agencies. So in conclusion, and as I end my remarks this afternoon, I'm pleased to thank the government of Uganda once again for organizing the 11th National Development Policy Forum to dialogue on how the country can best address the critical issue of lowering the cost of credit. I wish to reiterate UNDP's continued commitment and indeed that of our larger family and support towards the government's transformation agenda. Mweba lenyo, and thank you very much.
Thank you very much, Madam Ms. Elsie Atafua, the UNDP resident representative for Uganda. Thank you for all the works of UNDP, all the monies and the efforts and the recommendations you make. I have to tell you, they are all possible. In this room alone, we have the Minister of State for Finance, Planning and Economic Development. He's here. A hand clap for him, because we also have members of Parliament. Honorable Mwanga Chivumbi, he's here. We could have a hand clap for him. There he is. We have Honorable Herbert Tayebwa, he's also here. The Deputy Governor, Bank of Uganda, is here. The PSST, Mr. Ramadan Gobi, is also here. So everything really can happen. And we shall persuade them in more ways. So I'd like to invite PSST, Mr. Ramadan Gobi, for some remarks.
the Honorable Minister of State for Finance, Planning and Economic Development, in charge of economic planning, the Honorable Members of Parliament, the members of Diplomatic Corps, the Deputy Governor with the Central Bank, the Chairperson of the Board of NPA, the Executive Board and your board, and okay, thank you. All protocols, there are so many people in this room. I failed to really know who's here and who's not here. It's very heartwarming to see that Ugandans were interested in the conversations that pertain our lives. Honorable Minister, I would like to thank, first of all, the National Planning Authority so much for finally doing what the Planning Authority should be doing, leading conversations with the research. We are here to discuss how to reduce the cost of credit in Uganda. We all know that there are 4 major binding constraints to doing business in Uganda. The first one being that cost of capital. Uganda is a capital-constrained country. We don't have enough money to borrow, and countries develop when they create enough money to borrow. We also have a high cost of power, of energy, of electricity, which is the engine for economic transformation. We also have high cost of transport and logistics. And finally, we have a high cost and also low levels of adoption of efficient technology. As a country, we are still an inefficient, innovating country. We innovate, but inefficiently. So those 4 binding constraints are what we were asked in this medium term to address by His Excellency the President and also by the Cabinet. In this regard, therefore, I wish to commend the Planning Authority for commissioning this study, which I'm sure is going to help us to address the first major constraint to doing business. I've read through the paper of NPA. I've been able to look at its main recommendations, and I should say it's quite a very insightful paper. But I will comment a bit on a couple of recommendations, because I might not be able to complete the whole session with you, given the tight schedules I have. But when you look at some of the issues, for example, I was accused here that government borrowing from the credit market is one of the reasons why the interest rates are high. And it is true. when the government competes with the private sector for the same money, the way we've been doing, banks find it difficult to lend to the private sector at lower rates, at rates lower than what government is willing to borrow at. And in recent years, we've been borrowing at relatively high rates, but I want to soothe your concern that internally we have been also looking into this matter. How do we diversify our financing so that we reduce the over-reliance on domestic borrowing? So we are committed as government to pursue a strategy in line with our debt sustainability strategy of prioritizing concessional borrowing so that we reduce reliance on domestic borrowing. We hope that when we enhance these efforts, plus also the efforts towards export promotion and import substitution, we are likely to increase foreign currency inflows and reduce outflows. We are also looking at sequencing of projects so that we can be able to prioritize and not do everything at the same time, which has been putting a lot of pressure on us to borrow at very high rates. This, we hope, on top of bringing a bigger growth dividend, will help us to manage the high rates of borrowing. I mean the high rate at which we were going to the domestic market. Another issue I saw in the paper, which I'm sure you will see also later, was the comment on the government investment in the public banking institutions. There has been a debate on whether government should play a role in the banking business, and if so, whether government should directly own the banks or simply intervene with the subsidies and regulations. I know these are controversial issues to discuss, and there are also controversial issues in the conventional development economics with the different schools of thought. Many economists historically have answered those questions in affirmative, that government should play a role in the financial sector by owning banks and also by intervening where necessary. There are also others who have argued that state-owned banks tend to depress the financial sector development and thus stunt growth of the economy. The paper I've looked at has provided a balanced and a very conceptual analysis of this situation. And I hope today, before we leave this room, the role of the state will be clear to us so that we know what we need to do as a state to reduce the lending rates and overall cost of credit. As you know, we have done a number of interventions to reduce rates of interest through interventions like capitalization of the development bank. We have also put up a number of programs and projects to help Ugandans access credit at relatively lower rates than the market rates, including agricultural credit facility, including the Myoga funds, the small business recovery funds, and now the parish model, among others. We have also had our public banks participating in the space. But I don't want to go deep into my own views on this, because the paper is clear and you can't go against research if you are a disciplined person. Research is like a diagnosis. Sometimes it gives you bad results, but that's it. So I will listen to what the researchers have to tell us. Finally, I wanted to comment on the banking policy review and reform, which also has been highlighted, or will be highlighted to some of you. Stronger policies, especially in the banking industry, are vital in promoting efficiency of the sector. And this will allow banks to build their capital that can provide a buffer to absorb any losses and also overall position. There have been debates also on how our banks, I can see UBA and their chief regulator. That conversation I would like to bring it out clearly on how do we regulate banks in Uganda, and what does research say about this in terms of other places where they liberalized without full deregulation. We need also to discuss that. So I would like to end here by thanking you very much the National Planning Authority as well as my ministry and the Bank of Uganda for the conversation which I think this country has been waiting for many, many years, and I wish you very good deliberations. I will stay for a few minutes, Honorable Minister. I request that in a few minutes you allow me to go and do other things, but I will first listen to the paper. Thank you.
Thank you, PSST, Mr. Ramadan Gobi. Let's give him a bigger hand clap for his remarks. The two things that are noteworthy, and we whispered on the table there, Mr. Gobi was saying, you put in, you imagine it in Uganda, you put in 2.5 trillion and keep quiet. You know the way we talk these days. Take a 2.5 trillion or CDK. And then when you say finally researched conversations, that one got everyone's head nodding because they have been presenting research conversations over the years. And the last one I was at was on primary education, UPE. So I thought I should let you know that they've been doing very well. I'd now like to invite the Minister, Honorable Amos Lugolobi, Minister of State for Finance, Planning and Economic Development, for his remarks.
Thank you so much, Mr. Moderator. The honorable members of Parliament present here, the permanent secretaries, the UNDP country representative, development partners representatives, the chief executive, and the chairperson of NPA, government officials here present, of the Deputy Governor, Bank of Uganda, officials from the various banking institutions represented here, members of the press present, distinguished ladies and gentlemen. I think the keynote has been made actually by the Secretary to Treasury, and I'm left with very little to say apart from waiting for the main presentation. However, I'm honored to be part of this event because we have been talking about this problem for a long time, and it can only continue escalating until we find a viable solution to this problem. So I'm honored to be part of this event, the 11th National Development Policy Forum, reducing the cost of credit in Uganda and the case for public investment in banking. Let me take this opportunity also, like the Secretary to Treasury has done, to thank the National Planning Authority for putting in place such a platform and organizing this event, where the general public will continue and inform the recommendations on reducing the cost of credit in Uganda. As you are all aware, Uganda aspires to become a middle-income country by 2040 through, among others, directly investing in strategic areas to stimulate the economy and facilitate private sector growth and consequently national development. So in short, it's actually a partnership between the public and the private sector. Now, when we frustrate and strangle the private sector, like the Secretary of Treasury was indicating, then what we are simply doing is to curtail development. When private sector credit goes so low, we're actually endangering development in this country. So it's a problem that we must solve. One of the constraints to achieving national development goals has been the high cost of doing business in Uganda. And according to the Vision 2040, access to financial services still remains low. For example, 20% of the adult population in 2018 accessed financial services informally, while 22% have no access at all. Currently, bank accounts per 1,000 adults in Uganda stands at 206. So what happens to the rest? Where do they keep their money? Or they are not part of the monetary system? And these are two key questions that we need to ask. Why is it happening like that? Due to the low saving culture, there's a shortage of development finance, and the available funds are extremely expensive, thereby contributing to the increasing cost of credit. Most small and medium-scale enterprises in the country still obtain credit from informal financial service providers, some of these called money lenders, and you know how costly these can be and how many people have lost property through such arrangements. So there's still a big job to do for us. The government of Uganda is committed to ensuring increased access to credit by putting in place measures that reduce the cost of doing business, among which are strengthening collateral registration and the credit rating bureau system, individual identification, by establishing a national identity system, supervision to minimize collusion in the financial sector, and promoting public-private partnerships in favor of rural financial transformation. Given that our fiscal space has significantly reduced due to increased indebtedness, I should implore NPA to advise government on debt sustainability, because we have hit the debt ceiling of 50% to GDP. Now we need to innovatively find a mechanism for dealing with the problem, because the fiscal space is now very limited. Yet we have to continue investing in this country because the population is increasing and the pressure is coming from everywhere. We cannot run away from spending and investing public resources. However, we have to find a mechanism of increasing this fiscal space. And apart from ensuring that our GDP grows, we have to find a way of dealing with our current debt stock and sourcing, looking for opportunities where we can raise as government more affordable debt without crowding out the private sector. So I'm imploring the NPA to advise government on issues relating to debt sustainability and the possibility of government accessing green financing facilities, including, among others, carbon taxes, environmental levies, green bonds, and green loans, among others. I was recently having a discussion with the Egyptian Minister of Finance, and these are some of the sources Egypt is using to avoid the problem with Uganda is having today. So as a ministry, we are going to work very hard to ensure that we find these alternative and innovative financing mechanisms. In fact, discussing with other African ministers, we discovered that banks are actually not allowed to operate in this kind of markets. So we need to explore all these avenues to see how we address this problem. Many African countries, including Kenya, Rwanda, Egypt, have already access to such financing. I wish to affirm our total commitment as the Minister of Finance, Planning and Economic Development to support this agenda of reducing cost of credit and the cost of doing business in line with our mandate of mobilizing financial resources, regulating their management, and formulating policies that enhance overall economic stability and development. So we really need a new financial architecture to address the problems. We welcome the recommendations made by the National Planning Authority in this study, among which was a public investment in banking. With these few remarks, I once again thank you and wish you fruitful deliberations for God and my country. Oh, okay. I now take this singular honor to declare this meeting, this conversation open. Thank you very much.
I'm the one who reminded Honorable Amos Lugulobi that he has power. And so he invoked his power and declared the conversation open. And I must say, thank you for your remarks, Honorable Minister. A lot of people here do not know that the Honorable Minister is an old boy at NPA. So when he says NPA should be thinking about these things, he's really someone who can drive those tools and suggestions forward, because that's from where he came. We have honorables here as well. We have Honorable Kefa Chiwanuka. If you could stand up and wave. Most welcome. He's the Chairman Finance Committee. Honorable Kefa Chiwanuka, I should tell you, Honorable Minister was also Honorable Chairman Budget Committee, so it looks like people go in that direction. Honorable Abedi Bwanika, you're most welcome. Honorable Paul Kwizera Buchana, you're most welcome. There he is. People haven't seen you, so maybe you'd stand up again for, thank you. Honorable Katwesi J. Oliver. Honorable John Bosco Ikojo. Have we seen him? Yes, we have seen him. Honorable Nathan Byanyima. Honorable John Baptist Loki. Seen. Honorable Ruth Molly Undora Lematia. Honorable Jane Awoli. Honorable Phyllis Chamtai. Honorable Gilbert Olanya. Honorable Alan Atugonza. And Honorable Karim Masawa. There are some more honorables here. I think they have their masks on. When they unmask, I'll also introduce them and request them to stand for a wave. Here's another one. Honorable Maxwell Akora. Thank you very much for, so the PSST was right. This is a very powerful room, and a lot can happen. I'll take this opportunity now to invite the Executive Director, Dr. Joseph Muvawala, presentation on reducing the cost of credit in Uganda, the case for public investment in banking.
I thank you very much. I am not going to attempt to go into the protocols, given the time, but just allow me to introduce colleagues from AUDA NEPAD who are here with us in the country. You're all welcome. And also welcome the future economists of this country from Chira SS, the Economics Club. You're all welcome here today. This paper is going to be presented by myself and my young brother here. And he's going to use slides. I will use the old technology of my head because I'm not so much used to slides. The persistent debate in this country on high interest rates started a very interesting conversation in this country on whether this country should reopen the big UCB that we closed and sold. And it also started debates on how wrong we were to have closed that bank. And I think that debate has raged on and on and on. And we thought it is important to look at public banking as a whole, to give this subject a fair landing. So at the National Planning Authority, a decision was taken that in line with our mandate, we start doing this work of looking at the high cost of lending in this country, and particularly zeroing in on the public. That's the reason why we went for the public, because the public was clamoring for another UCB. And indeed, we can see that the lending rates in this country have been very high and are still very high. And the UNDP representative and all speakers have told us not many countries in Africa have rates as high as ours, that are countries that have had very stable macroeconomic environment like ourselves. So these costs over the years, as we know, have impacted on private sector lending, and we know that we are in an economy which is private sector led. And make no mistake, ladies and gentlemen, government has done all it can. Government has put in place monetary policies. You see our bank rate, the lowest ever in our times. We have invested in the development bank. We have also invested in de-risking by registering our population, giving them identity cards, registering titles as much as we can. We have financed, put money in microfinance. We have had programs like Emyoga, SAGE, UWEP, and we have also had reforms in the banking sector like the disclosure of interest rates and other bank charges. However, the rates still remain high. And many studies done by many people, including the IGC, for whom we have a team here, and ourselves have looked at this area and could discern the causes of this high interest rate. And the first culprit in these causes is the high operation costs by banks, which contribute about 60%. The second are the loan loss provisions and high default rates, which contribute around 10%, our behavior. The other is profit maximization, 10%. And other factors like bank policies, undercapitalization, local credit market inefficiencies, and the one that my brother has talked about, government borrowing, for which some of us are very responsible for. Now, the papers that we are presenting today with my brother discuss 3 pragmatic policy measures for mitigation of the root causes of the high rate interest, and these have been extensively studied. So one of them that we propose is that government should deliberately invest in public banks. The interesting bit, like my brother will tell you, that many Ugandans don't know that government already has 3 banks. So when they clamor for a commercial bank, just telling them that your government already has 3 banks could solve that problem, and you deal with it. These papers are very, very detailed in their analysis, and we are proposing that it's not a very good option for you. Actually, it's a very bad option for you to start a new bank again. Because with the culture of banks, it takes 10 years for a bank to bed. So you would be wasting a lot of time. It's not a good thing. We are also saying that you already have 3 banks. Pride Microfinance, which is excellent at circles and groups. You have Posta, which is excellent with the lower segment. Your housing finance, which is good with the high segment. So and there were options we looked at. Should we combine these banks into one bank? People were saying so. But the study is coming out strong to say, don't. Each of these banks bring you a very big advantage. Pride gives you the circle lending, the group lending, they're the best in the country. Posta gives you the low segment of the income. And housing finance gives a higher segment, and mortgages. So the final recommendation we make in this area, invest in these banks separately for you to have the highest benefit. My brother will give you the amounts of money. I don't want to scare you. And Honourable Minister, as you know, you directed us to look at all public institutions that make money and take government money. We'd like to inform you that the most profitable of all of them were banks. They are the ones that are giving government the highest profits. Whether it comes back or reinvested, that's another matter. So it tells you that it is profitable for government to invest in this area. The other issue is that new businesses and all the others we have started, we can see it with the Uganda Airlines right now, are also suffering governance problems. So whatever you do, as we bring back these investments, the governance of these banks must be reinforced. So we're also calling for bank reform, which my brother will look at these issues. And I already know, Honorable Minister, that with you is already regulations for increasing minimum capital requirements of banks. We think this is a very good thing, but we are also saying, as we increase the minimum capital requirements of banks, we should be able to bring down the NPL ratio, to take it up, such that the risk these banks begin to play a little bit safely. We are hoping that when this happens, when these regulations are passed, the other carrot should be that my brother and the central bank looks at the other side. As we increase this side, we also increase a little bit this side. Because since capital is going up, then I think people could become a little bit risky and allow them room to play. The other ones are programmatic measures by government to reduce borrowing. And I sit on top management. Every day we think about this. Government must reduce borrowing from these markets. And the other issue that we are raising to you, that this country should have fair lending policies. It should be criminal not to lend to the youth and the women and the vulnerable. Something should happen. May I call upon my brother, my young brother, whom I'm very proud to introduce to you, Mr. Sebukera, to quickly give you the details in the shortest time possible so that we can now discuss. And I want to thank you very much. This is the first time NP has received the PSST in our midst as we present. The first in my 8 years as the executive director. And the first time we have received more than 10 MPs. Yeah? We always receive the governor, so you're always welcome here. Yes.
Thank you, Edie. Just to pick it up from that, Right Honorable Minister, and gentlemen and ladies, for us to arrive at these findings, National Planning Authority undertook 3 thematic studies. And these thematic studies were able to guide us to arrive at the policy recommendations that have been presented. One study focused on the setup and operations of banks. Particular focus was on our public banks. The second study undertook a comprehensive analysis of the financial and economic performance of government investment options in banking. And the other study undertook a comprehensive analysis of the performance of banking in Uganda. I want to note that this work was not done by NP alone. This work was done by a committee on which we had the Bank of Uganda, the Ministry of Finance, the Uganda Bankers Association, the Capital Markets Authority, and we had representation from the 3 public banks. That is Housing Finance Bank, Post Bank, and Pride Microfinance. Now, in terms of setting the agenda for this study, in terms of setting the context, I want to build already on what has been said and emphasized, that majority of the Ugandans actually are excluded from the banking sector in Uganda. Now, from the economics point of view, that's a market failure. It means you have majority of the people who want to access the banking sector but are unable to actually access banking services. And what do we note from this nature of economy? That we have about 22% as an average lending rate, over the years, and that this high cost of credit, averaging about 22%, we shall get to put this in perspective. How high is 22%? Why do we say it's high? But what we know, that this has limited the growth of strategic sectors of the economy, and that you find that about 20% of Ugandans only have access to collateral. And if you don't have collateral in this economy, chances are higher that you will not even be able to access credit. And if you live in rural areas, which is true for about 75% of Ugandans, it is also more likely that banking will not be your usual phenomena, because banks are actually largely an urban phenomena. And government has not been seated. We've implemented a number of measures, and I think when the PSST was making his remarks, he emphasized a number of policy measures that government has implemented. Monetary policy measures, several of them. We've had development banking. We've invested heavily in development banking, UDB. We have also financed microfinance support initiatives, transparency initiatives in banks, disclose interest rates and any other charges. And we have also reduced population risk. But look, if you look at the curve in the corner of the presentation, the line above is the average lending rate for Uganda. What you note is that the average lending rate for Uganda is far higher compared to its East African neighbors. That while our lending rates average about 22%, others average about 14 to 16%. So we undertook to understand what actually drives lending rates in Uganda. And of course, this has been talked to so much by my ED when he was presenting, and there are a number of factors. But I'm going to emphasize on a few that are really the driver for the thesis we are presenting and the recommendations we are making. Of course, operating costs contribute about 61%, account for about 61% of the interest rate spreads for our commercial banks. But interesting within those is that actually profit maximization by banks contributes about 10 percentage points on the interest rate spreads. But beyond this, we note that actually underinvestment, government underinvestment, or the undercapitalized public banks are not doing much to save the situation with regard to passing signals on the lending rates on the market. So undercapitalized public banks are actually critical in determining the state of our lending rates in the economy. But most importantly is that government borrowing and certain bank policies are critical in driving this level of lending rates within Uganda. So having understood these critical drivers of lending rates in Uganda, the study undertook to map the pragmatic policy measures to the critical root causes of lending rates in Uganda, to be able to determine the root cause, but also the solution to addressing the high cost of credit. And when we look at the mapping of the key interventions, one of the key critical recommendations that comes out from the study is that we must invest in our public banks. And the key question is, why must we invest in our public banks? We find out that actually, that due to the small size of our public banks, Uganda's banking industry is controlled largely by the private banks, majority of which actually prioritize profit maximization at the expense of national development priorities. That's a very important statement. And to bring this home, look at the percentage of the market share that our public banks control. Uganda's public banks control about 7% of the total market assets. And if I compare, for example, with our East African neighbors, when UNDP was presenting, they took it even a bit far. Let's not go too far. The situation even becomes worse when you go out of East Africa. But first for East Africa, Kenya controls about 22%. Public banks in Kenya control about 22% of the banking industry. Tanzania about 27%. Uganda only 7%. So what does this mean? It means that our public banks are followers of private banking institutions. And in banking, it is all about sharing practices and best practices of market leaders. So the practice of market leaders will most certainly be the practice of its followers. So that means that the practice of private banking institutions are driving the behavior of the market in Uganda. Now, we undertook a brief survey as part of this study to find out public perceptions about our public banks. But very interesting, we found out that government ownership has a positive impact on the demand for public banking services. And we found out that at the right price, at the right products, government banks are actually preferred than private banks. We asked just 4 questions to the public. The first question was, have you ever heard of Pride Microfinance, Post Bank, and Housing Finance Bank? Majority, actually, about 80% said they knew about these banks. And less than 20% were actually not aware of these banks. And then we asked a second question, that do you actually have a bank account with any of these banks? Now, that was the reverse in percentage. Less than 20% actually affirmed that they had accounts with these banks. Then we asked a third question, that do you know that Post Bank, Housing Finance, and Pride Microfinance are actually government banks? And the majority said they didn't actually know that these are public banks. And the final interesting question was, will government ownership positively influence your decision to open accounts with these public banks in the future? And the majority actually said yes. And we asked why. We are very interested in the why. In banking, it's all about trust is a critical asset for any bank to thrive. Now, look at the responses from the public. The public gave the top 4 most responses. 1, trust. 2, that they expect low interest rates. 3, it will be easier for them to access loans. And 4, that they are willing to lend to low-income groups. So the public's perception of government-owned banks is that they are more secure, and people will not incur losses due to a bank closure, as rudimentary as the findings are. So this is a first fundamental variable when you are considering any intention to go into public investment into banking. Why? Because without trust, you cannot actually, without trust, you cannot have meaningful investment and impact in the banking industry. The key question that we had was, how do we then invest in banking? Yes, we know it is critical for government to invest, but how? The study, just like the executive director explained, had a number of options to analyze on how can government invest. And the strong option was, let's revive UCB. And I identify with a lot of you that actually there was a lot of push, even towards the approval of the 3rd National Development Plan, that UCB should be revived. But technically, the study said, let's take a bit of more deep analysis to this. And there was an option that let's actually acquire an existing bank and make it a public bank. The number of them, if Centenary is one of the well-functioning banks, let's acquire that one and make it a public bank. But also, that we have these 3 public banks. Why don't we consolidate them into one bank and come with a big bang on the market? But the other interesting option was, but if they are already existing public banks, why not strengthen them independently, since each has their own niche? And the study, the analysis found out that strengthening these banks independently, due to their existing unique niches, was the most financial and economically viable option for government. So implementing this intervention will require us to intentionally have an intention to drive towards lowering interest rates and focusing these banks on those niche areas. We know that Postbank is a strategic bank for lending to priority NDP areas. Pride Microfinance, the group lending, and Housing Finance Bank is critical for urban infrastructure going forward. Now, we were also critical in this analysis. By the time we undertook this analysis, Postbank was actually a Tier 2 institution. And just in quarter 4 of the last financial year, Postbank was advanced to a Tier 1 financial institution. So already this is a positive move towards strengthening the strategy on government investment in banking. But the key question is then, how much, if we know how we need to invest by strengthening each of these banks, how much then shall we invest in these banks? What we are saying, and this is a very critical statement for this study, is that for government investment in public banking to be effective in creating the effect on the economy, public banks should become market leaders and should take up 20% of the banking sector portfolio, and this should be attained within 7 years. There is a critical reason for 20% market share. Reason being 20% was, we did a lot of iteration on what optimal share of the market is critical for public banks. And we found out that if public banks control 20% of the market, it's a good share to actually influence the market, but it is also a good share to minimize risk that public banks would impose on a private sector-led economy. So 20% market share should be a critical target for us with regard to our target to banking. And for us to be able to attain this 20% market share, we should allow our public banks to grow to the extent that Postbank is able to control 13% of the market, Pride 3%, and Housing Finance Bank about 4% of the market. And for this to happen, you need to invest about 2.5 trillion within these public banks. Now, that's a very high figure. The key question is, what is the source of funds for this 2.5 trillion? Of course, we have our honorable members of parliament. They know that finding 2.5 trillion in the budget to invest in banking is very hard. But what is the source of financing to invest in this strategy for government? What we are saying, this investment is split into two. You need about 1.5 trillion to just be a portion of the current government business to be channeled within these public banks. Now, we have a lot of government programs actually being implemented through private banks. I've seen UDC here, somebody from UDB. Who is the banker for UDC? Who is the banker for UDB? How much money are we putting within these development banks? And could it be that the private banks are actually using our capitalization to lend back to the economy? So what if we lent a portion, we gave a portion of this banking business to our public banks? What would be the impact? We have a number of government programs that we are implementing through local governments and through other social assistance programs. And most of these, we are implementing them through private banks. What if a portion of these, amounting to government business of 1.5 trillion annually, is going through our public banks? And this alone, you cannot imagine how much impact it has on impacting on our lending rates. Now, what we are saying is that only 1 trillion out of the 2.5 trillion is required as direct investment within our public banks. And this is critical to invest in clear areas of digitization to increase efficiency within these public banks. So what we are saying is that since we are a private sector-led economy, we cannot say that let's do business with public banks. No. But what we are saying, we must be deliberate to channel a portion of this business with our public banks. And there are a number of detailed proposals, technical proposals on how this is possible within government and within the operations of government. Now, we are talking so much about increasing investment in banking. The critical supplier of credit is actually through savings. Now, you cannot complete the discussion on lowering lending rates without talking about the impact that you have on your savings culture. Now, we need to be deliberate on mobilizing savings at public banks. And one is we need to increase the new-to-bank customers. But most important is how do we manage dormancy rates within our banks? Now, the study found out that about half of the savings accounts within the banks are actually dormant accounts. The situation was not different before and after COVID. So for us to be able to address the lending culture, the first target should be around addressing the issue of dormancy. Feedback we have received from this study indicates that it is more complicated for you to activate a dormant account than start a new account. So how do we start to address issues concerning financial literacy, to be proactive about mobilizing our savings and encouraging customers to actually easily activate their dormant accounts and review the policy measures? But most importantly in this discussion is when we did this study, there was a thinking that the poor actually don't need credit, that Uganda is highly subsistence economy. People have their food, they have their cassava, and they are able to survive. But actually the poor need credit. The key question is, how do you lend to the poor? And the answer is by implementing fair lending models that are you only lend to the poor by implementing appropriate models that are appropriate for the type of the economy. And we found out that actually banks in Uganda are implementing what we call prime lending models in an economy that is largely subprime. So you need a subprime lending model in a subprime economy, and this is what we are presenting. So a subprime economy, what does it need? One, you need to offer affordable and accessible products by the majority. Issues like group lending. Stanbic Bank, prior to the conclusion of this study, actually started piloting a program. And they implemented the Stanbic Enterprise Restart Program. Lending, they mobilized financing from a number of development partners, and they have been lending success. This is one of the most successful products of the bank, lending at 10 to 12% to agriculture and other sectors. How do we cascade these models to the wider banking industry? How do we focus proactively on credit risk management and reward good behavior within banking? So if we have good banking, good credit behavior, how do we reward it with lower interest rates when they come back? And of course, issues to deal with financial literacy going forward. We have learned a lot from the money lending model in Uganda. Why are money lenders in Uganda very successful? What lessons can we learn from them? Money lenders are actually successful because they are addressing a market failure in the banking sector by providing loans to the majority who are excluded from borrowing by banks. Why? Because majority, if you look at the demographic behavior of Ugandans, majority don't have collateral, they are low income, earning about 500,000 annually. They give quick loans. They are available when you need them to smooth your consumption tomorrow. And the speed of loan processing is actually very important to a borrower when they are in need of financing. And of course, there is low literacy, and majority of our borrowers actually live in rural areas. And money lenders have been successful because they offer unsecured products. They are able to lend you even when you need 100,000, which is comparable to the minimum average monthly earnings. And loans are approved within a day or less, within hours. Their application processes are very simplified, and they are easy to access even in rural areas and communities where they live. Now, even when money lenders are successful, they are actually predatory to the economy. Because if we bring the computation of numbers for the money lenders, then Ugandans are actually losing 5 times more than they actually borrow from the markets, from the money lender markets. So they are a typical example of a black market, but thriving effectively and efficiently. But we can learn some lessons from them and be able to strengthen our banking culture. But if we are to invest in banking, there are opportunities and risks in this agenda. One of them, as already been emphasized, is corporate governance of the public banks. So Pride, Housing Finance Bank and Post Bank, as we increase our investment in these banks, how do we put in place strong governance principles? Even when it means forcing these banks to list on the stock exchange, for purposes of transparency, to attain certain performance measures, it will be necessary going forward. How do we attain operational efficiency at these banks going forward? Now, there's a very interesting role that taxes play in this discussion. Now, we've always increased private sector credit to allow growth of small and medium enterprises. But findings from this study indicate that a number of enterprises prefer to stay small because they want to avoid growing big to hit a certain tax bracket. So how do we effectively deal with the issue of taxes? And we found out actually from the responses that a number of small, medium enterprises had evolved into different enterprises for the need to remain small. So how do we discuss broadly the issue of tax policy and how it influences and impacts on our discussion going forward? The impact of the judiciary, we can't afford to take 9 months solving a case at commercial courts. We need to bring this down to a minimum turnaround time of 3 months. And the impact of land policies on access to collateral, the NDP target to increase titled land is about 60%. And we are currently just about 20%. So how do we increase the percentage of the people with titled land? And then the impact on private banks in a free market economy. If you take the strategy to invest in public banks, in a free market economy, you have to put in place a number of measures that ensure that these risks don't spill into the economy going forward. The risks of public administration don't actually find themselves into the economy. And there are a number of models of how this can work. For example, when public corporations are borrowing, we've been forcing them to actually go and borrow from public banks. But we understand that our public banks are not able to mobilize sufficient capital for public corporations to borrow. If Uganda Development Corporation, for example, wants to borrow, they can't mobilize 200 billion from, for example, Post Bank. Maybe Post Bank is not even able to underwrite this level of borrowing. But what if we put in place measures that encourage our public banks to actually learn from private banks through policies like syndication financing? So how do we encourage, for example, that if we are to borrow from Stanbic, it should syndicate with the public bank? This way, we are giving opportunity for the public bank to actually participate in business, but also build their capacity going forward. A critical discussion in this is the role that mortgage financing has to play in especially mobilizing financing for real estate and the construction industry. Close to the last major intervention within this is banking policy review and reform. Now, the study found out that there are a number of policy measures in place introduced by policy that are actually contributing to increased lending rates within Uganda. For example, I'll highlight a few. We require banks to submit particular documents as part of the requirement and store them for a minimum period of time. We found out that, for example, for Stanbic, that banks only have 1 million clients. They spend about 5 billion in terms of costs for storing stationery annually. When we visited these other public banks, they spend 2 to 3 billion annually in stationery costs. How do we embrace digitization and review these policy measures to be able to actually reduce the cost of credit? And another policy measure we found out is that banks are actually required to remain within the restriction of 5% non-performing loan policy. This policy measure is good. It encourages banks to minimize risk, but however, it reduces financial inclusion. So what we are saying is that as we are revising the minimum capital requirements for banks, it is the right time now to talk about increasing some appetite for risk. So how do we revise the requirements for non-performing loans going forward? Of course, issues concerning tier restrictions need to be discussed. There is no reason why tier 3 institutions should not be allowed to have urgent banking. Yet it's actually the future of reducing the cost of operations for banks. So going forward, we need to review some of these policies within the banks, enforce fair lending practices within the banking industry, and this will be critical for going forward. We have consumer protection, but how do we embed within these guidelines critical measures to actually protect the economy from high lending rates? So in summary, therefore, what we are saying is that we need, going forward, government will need to implement a number of policy measures. Some of those that are critical are specific to the banks. One is we need to invest in our banks, and a total of about 2.5 trillion is required to invest in our public banks. Two is that we need to review certain policy measures within the banks. The 5% non-performing loan requirement, though good, it may need to be revised, especially as we increase our capital requirements. The turnaround time for addressing certain administrative procedures, for example, acquisition of national IDs, conclusion of courts, of commercial cases within the commercial court, all of these need to be addressed. And of course, issues concerning increasing access to titled land, among others. I want to thank you very much for this.
Thank you very much, Mr. Henry Serukera. A lot of brain power there in the presentation as well. Really, he deserves a bigger hand clap. I actually thought of recalling him earlier, but then when he started saying things like the prime rate is very unfair in a country that is not so prime, then I thought, really, this man should talk some more. So I think you agree with me. He deserves another hand clap for that. And Wilbrod Owor was looking at him, and I hope Wilbrod will take that message about that prime rate, because we've allowed the man to speak some more because of a prime rate that really needs to go down. I'd now like to invite the Deputy Governor of Bank of Uganda, Dr. Michael Atingi Ego, to very briefly discuss points raised. Dr. Atingi Ego, you could just say, I agree, Bank of Uganda is going to find these monies, and we just move on.
Yep. Thank you very much. All protocol, as earlier mentioned, is observed. A very good afternoon, ladies and gentlemen. Thank you for taking time to come and participate in this very interesting conversation. I also would like to thank the National Planning Authority for coming out with such a brilliant paper, brainstorming lots of issues that may be having different views on it. But without leaving you guessing, I think I agree with most of the recommendations, and what I'm going to do is just add a few things and leave for you to decide where I'm coming from. So let me begin by saying that the key recommendations of this paper, which includes government investing in Uganda's public institution for a total amount of 2.5 trillion, banking policy review and reform, and then reduction of government borrowing from the credit markets. So I'm going to present my presentation. I'm going to address or make my remarks in two areas. First, I'm going to look at the 2.5 trillion investment, and then I'm going to give us a broader picture. What is really causing the lending rates to be where they are? I know some factors have been mentioned, but I'm going to try to add some numbers to that to make you appreciate where we are. And then I will then look at the other issues like the banking policy review. So if you could take me to that slide, there's a slide on public investment in banking. It drew my interest. Do you have that slide where it shows country Kenya, Rwanda, Tanzania, Uganda, the bank name, and the government ownership? Are you there? It's on. The slides are not numbered, unfortunately. But it says public investment in banking due to the small size of public banks. Slide 6. Okay, but if you're there, there's a very interesting discussion which I would like the members of parliament also to think through together with the Honorable Minister of Finance. You know, in Kenya, there are 3 banks that have been identified there. These are public banks, you see. The government ownership, for example, of the National Bank of Kenya is 22.5%. Their total assets is 1.12 billion. All right, and then the public market share is 22. I want us to critically look at those government shares. So, for example, the National Bank of Kenya has a government ownership of 22.5%. Who is owning the 77.5%? Maybe I would like to be guided by NPA. Who's owning the 77.5%? So if we're looking for 2.5 trillion, maybe these guys have got strategic investors who have put in some money, right, to be able to sustain their total assets of 1.12 billion and have a capitalization of 25% market share. So the question is, does it have to be government to provide the entire 2.5 trillion, or we could strategically think that how do we bring in strategic investors into these public institutions so that they bring in new business models, corporate governance, and what have you, and government continues to have a share without necessarily looking for 2.5 trillion, which could go and do some other activities, investments in public infrastructure. It's food for thought. I was looking at it just when I came, because if you look at Uganda, look at Rwanda, where government ownership is 100%, all right? No, okay, let's just look at Uganda. Housing finance has 49% government ownership, but at least its total assets are higher. They are at 288. So maybe the 51% who is not non-government has brought in some money. But if you look at Post Bank, you look at Pride Microbank, 100% ownership. Where are we in terms of capital? Food for thought. Just using the slide. Let's think about it. Do we need a 2.5 trillion from the Treasury, or can we look for some strategic investor to partner with these banks so that we bring good business models, good corporate governance? That's one thing. Now, let me go to my main points. Why are interest rates high in Uganda? It has been mentioned that I like the idea of the non-performing loans, and then the issue of the commercial courts. Look, I was told that there's about 4 trillion shillings hanging in there, locked up in unresolved court, unresolved loan contracts hanging in court. Then this morning I learned that the figure is actually as high as 7 trillion. You see, there's a culture that is brewing up in Uganda, which is very dangerous. People want to borrow money. When it comes to paying, some of them have the capacity to pay, but their willingness is not there. Then you run to court to seek for court injunction. In the meantime, The banks have locked in their assets there. Now, like this 4 trillion, if the number 7 trillion is true, these are depositors' money for which commercial banks are paying interest. When you want to go and withdraw your money, a bank cannot say, you hold on, I have money locked up in a court. No, they have to pay, they have to look for money. So what do we do about these guys who borrow money, don't want to pay? When they want to foreclose their assets, they run to court. I think we need to change that culture. It is bringing a very bad image for Uganda, both nationally and internationally. So you cannot really fault commercial banks or supervised financial institutions for keeping the rates high, because this is capital they are now eating into. Sooner or later, they are going to provide for that because it's an NPA, it's non-performing, right? So next time you go and borrow, they will say, this guy, he might run to court, all right? So let me add the rate a bit, okay? And if it runs to court, I have to look for more capital to make good for the money that is there, because tomorrow the regulator, Bank of Uganda, is going to say, well, according to the time for this loan classification, you either provide 100%. So you have to go and look for capital from somewhere. And that's a lot of money. That's one thing. And then the other thing is domestic arrears. Honorable Minister of Finance, the verified arrears, I'm told, is about 1.6 trillion as of today, close to 1.7 trillion. That's verified. I do not know how much is unverified. Now, some of these guys have supplied goods and services to government, and if government is not paying them, this again hits the assets of the commercial banks. So what happens? They have to provide again, like I mentioned, because sooner or later they have to classify it as non-performing, but depending on the time, they have to provide for that money. Then you mentioned one thing, government borrowing. Government borrowing affects the government securities rate. And when commercial banks are pricing their lending rates, they do not really look at the CBR. They look at the safer set, right? Let's take, for example, a 364-day treasury bill, right? If that rate is 10%, then they will begin saying, okay, how risky is this guy? Then I will add a premium on the 10%. Now, if government continues to increase its borrowing appetite, those treasury bill rates will go up. And indeed, if you look at in 2020-21, government borrowed from the domestic credit market 6.8 trillion shillings. 6.8 trillion shillings. And if you look at the interest rates on government treasury bills and treasury bonds, they are the highest in East Africa. So in as much as you are showing those lending rates that Uganda has the highest lending rates in East Africa, you need to unpack what is causing those lending rates to be the highest in East Africa. If government, who is considered as the safest borrower, is raising the risk-free rate, which is the treasury rate, all right, then the banks are going to begin pricing at that. So the good news is that government is undertaking fiscal consolidation. In 2020-21, they borrowed 6.8 trillion from the domestic financial markets. And then for the financial year ending June this year, they had planned to borrow 3.4 trillion, which is about a half of what they borrowed last year. So that again partly explains why the yield has shifted down, because government is not going so strongly. And if I look at the borrowing numbers for 22-23, the members of parliament here will correct me, but at the time when we were looking at the framework, the net domestic financing was 1.9 trillion, but given the fluidity of government expenditure, I don't know whether it's still 1.9. But if it's 1.9, that is a very big improvement that government is actually undertaking fiscal consolidation, and maybe that's going to drive the interest rates down. Now, what's the way forward on this? The way forward on this is for those, for the assets that are locked up in courts because of the litigation cases, the Minister of Justice is working together with the Ministry of Finance to see how they can increase the number of judges so that they settle these cases that have been dragging in court for a long time. These guys who haven't been able to pay, how quickly can they settle those cases and then make a judgment so that these numbers of 4 to 7 trillion come down? Maybe that will be important, but also it will be important to monitor that what is happening. Is there a net reduction in the money locked in there, or is it increasing? Because it's not the number of judges that matters, but how are they performing in terms of reducing the amount of money that's locked in there. And then, of course, the other thing is the profitability of the banks. I know that we had been told that, that the high costs contribute to, that the operational costs contribute 60%, and then provision for bad loans is 12%, and profit 10%. Well, one can say, where are banks making a lot of money? That is a discussion we can have, but also need to look at the riskness of the economy, and if they happen to make their profit, what is the risk-adjusted profit for that? So we can have the discussions, but we need to look at this. Now, let me then look at the issue of the high operating costs. The costs are very high, largely because of the nature of the banking system in Uganda. In the past, we used to have branches dotted everywhere. For those of you who are old enough, you remember UCB was pursuing the rural farmer scheme. They opened a branch in almost every, I don't know, is it parish or what? So those costs are definitely very, very high. But the good news is that that is changing. It's changing with technology and also with the central bank policies. Ever since we introduced agency banking, we have seen the number of branches contracting. Now, if you look at the agents who have been registered to transact business on behalf of the central bank, of the commercial banks, you find that those who are registered is close to 22,000, but the ones who are active are about 18,000. So what is the implication of that? The implication of that is that the bank does not have to have a branch everywhere. You need to have an agent in a hardware shop, in a petrol station, I don't know, even a hair salon, as long as they meet the requirements. And the beauty about it is that if I'm a vegetable seller in a market, let's say in Kiwatule, and I have made my sales for the day, at 8 p.m., I can go to an agent, maybe a petrol station, put in my deposit there, withdraw the following day, and by so doing, you are establishing a record of your financial transactions. And if you have it long enough, sooner or later, you have a long history of your transactions. And people can then see, what are your withdrawal patterns? What are your saving patterns? And that information is very, very critical. And that will even lessen the need for collateral, because the behavior of a person in terms of financial transaction is much stronger than a collateral. A collateral, somebody can just run to court, put an injunction when you want to foreclose the collateral. But looking at someone's behavior, right, is a very, very important thing. And then, of course, the other issue is the technology. Fintechs are doing a great job, particularly in terms of mobilizing those at the bottom of the pyramid. If you look at the transactions now on these new modes of payment, the biggest and the fastest growth is at the lower end of the pyramid, transactions which are less than 50,000. So that's where the fastest growth is. So that implies that, right, technology is doing something about financial inclusion. So combine that technology together with agency banking and the fact that commercial banks are linking up with fintechs to begin offering financial products, we are likely to see a structural transformation take place in this economy. So I agree with the recommendation that, one, to recapitalize these public banks, they need to focus on technology, and I also agree that agency banking should be advanced for micro-deposit institutions, not only for tier 1 institutions. So that is a good point. Now, let me talk a bit about other factors. Why are rates high? The other issue is you need to look at the maturity structure of the assets and liabilities. the kind of institutions we have today mainly get liabilities at the short end of the market. But because we lack development financial institutions, we all run to the supervised financial institutions for capital investment. You want to build a school. You want a 10 or 5 to 10 years. These commercial banks have got liabilities, deposits of 1 or 2 years. So for them to give you a loan of 5 to 10 years, it means you are creating a maturity mismatch. So they need to begin to see, how do we transform a short-term liability into a long-term asset? And that is very, very expensive. So that partly explains why the rates are high. So how can we bring in institutions that are meant to address capital investments of a long-term nature? Maybe that will solve the problem so that the supervised financial institutions only provide working capital, and maybe the interest rates will come down. So the argument now about, do we have another UCB? Do we amalgamate housing finance, private microfinance, and post-bank? Or do we allow these institutions stand alone? You see, one needs to go and look at what is the history, what is the debate between publicly owned supervised institutions and privately owned. The whole debate surrounds on market failures and public sector failures. There are failures in both ways. Even if you pursue a market, there are some failures. Even if you pursue publicly owned banks, there are also failures there. So we need to ask ourselves the question, what is it that this proposal is addressing to minimize the public failures? And I'm glad to mention that they have tackled most of the issues that would have caused public banks to fail. So they have emphasized on corporate governance. And corporate governance is very, very important. Because now, if you look at the governance structures of housing finance bank, post bank, private microfinance, the governance is strong, all right? And then each of these institutions has got a niche, like it was mentioned by the ED and the presenter. Each of these institutions has got a niche. So why not grow that niche together with strong governance, increase the capital, so that these banks are able to pursue their objective as government has indicated. Now, the danger about combining this into one institution is that this one institution is going to have a multiplicity of objectives of government. And once you have a multiplicity of objectives being undertaken by one institution, you lose focus and you begin misallocating resources. So whereas if you run these institutions on their own, you capitalize them very well, you have a good corporate governance, they have a niche, they have a good business strategy, and they pursue these digital financial transactions together with agency banking, then we can talk about strong publicly owned financial institutions. But also consider my first point. You should invite other partners to join you, because they might come with new ideas, new business strategies, new solutions that might change the whole game plan in terms of increasing the things here. So let me conclude by saying that the proposal then to increase the government of Uganda funding in public banks is most welcome, especially at such a time when there are emerging risks. The emerging risks in terms of climate, in terms of cybersecurity, in terms of these data issues. And that's why this is now linked to the banking policy review and reform. Recently, the Uganda Bankers Association submitted to Bank of Uganda what they call a regulatory reforms report. This report is trying to address that, how do we have a sustainable financial sector? A financial sector that is resilient to all these emerging risks. And we are working, we are providing our comments. By the end of June, we'll be looking at all these issues. So these regulatory reforms will inform this report even further, so that we're able to meet the emerging challenges. Now, there were some issues that have been raised about should Bank of Uganda increase the NPA ratio. Once you expand the capital, of a financial institution. You are increasing the denominator. Then you can have a bigger absolute value of your risk-weighted assets. It's very simple. That's why today you have banks that have a huge capitalization. They're able to venture into more risky assets. So it's not by raising the non-performing ratio to 10% that you bring in risk-taking, but it's by increasing your capital, all right? And even if you increase the capital, there is the timing of the classification of these loans. After a certain time, you're supposed to provide. So we can have a debate on that going forward. And then finally, these money lenders. Look, we did a survey recently, financial capability sustainability. We found out that financial knowledge and financial behavior are critical in forming decisions. We asked the respondents, if you took a loan with a monthly rate of 3% compared to a one-year loan of 15%, which should you go for? They all went for a monthly loan of 3%. That is much cheaper than an annual loan. So that financial knowledge, we need to do a lot in terms of, and this is what the money lenders are doing. They're giving you 10%. They'll tell you 10% per month. You go to a bank, it's 20%. Now, a guy does not know that 20% is for 1 year. All right? Then you go for 10% for 1 month. This was what the survey revealed. So we need to do a lot of financial literacy on that. And then the behavior, when to borrow and when not to borrow. The behavior needs to change. And then again, let me repeat, we should pay our money. Pay up your loans. The survey found that, even paying of a loan, there are very few people really who are interested in paying a loan, but they want to borrow. They have the capacity to pay, but the willingness sometimes is not there. The Bible says the spirit is willing, but the flesh is weak. Okay, then I will leave it at that. Distribution, the role of the public banks. Yes, it's good to give them government business, but the question is, do they have the infrastructure to deliver the intended objectives of government? Is there the capacity? So if we want to do that, let's do it gradually. As you capitalize these banks, as they develop the infrastructure, then maybe can consider, but to give them to begin delivering government services with poor infrastructure, you will end up again coming to the private banks. So I want to conclude by saying, thank you so much, NPF, for generating this debate. I think there are lots of things here, but I agree that we need to strengthen the public banks through either partnership. If government has got a pass, they can give them the money, but my preference will be, how do you bring in strategic investors to invest in these public banks? They come with fresh ideas, good business models, corporate governance, and so forth. I thank you so much for your kind attention.
Thank you very much, Deputy Governor, Dr. Michael Atinyego. He deserves another hand clap for sure. I had wanted to limit his time, and then he started talking about paying back courts. These are very touchy subjects right now in Uganda's environment. So let's give him another hand clap for being so brave to talk about those things that parliamentarians have not yet talked about. We also welcome Honorable Maxwell Akora. If you could stand up and do a little wave so people see you. Honorable Avur Jane Pachuto, she's here. All the powerful people are here. Enterprise Uganda, Mr. Charles Ochichi is here. National Chamber of Commerce, Mrs. Olive Chigongo is here. Thank you, thank you. And for you listening or following discussion on Twitter, thank you very much. Continue following discussion. We have others watching on NBS. Thank you very much. Continue with us. And others on YouTube. Right, we now have 4 panelists. and I will allow them 7 minutes each on the panel. We have Mr. William Biandustia, who is also a Rotarian of my Rotary Club. He's a businessman and a managing director of Master Woodworks Limited. He's one of the leading manufacturers and suppliers of locally made high-quality furniture in Uganda and East Africa. Master Supermarket Limited and Master Wood Investments Limited. He started working as a teacher before joining business way back in 1983. Then we have Dr. Wabukao Veronica, is a credit risk management consultant. I'll ask her to talk about fair lending as well. She's experienced and accomplished professional with many years experience in private banking and finance, specialization in credit risk management, and other years prior experience in economic development and policy research and teaching. She has worked in different capacities as Vice President Credit Risk and Policy at HSBC, a researcher and also with managerial duties. She's a PhD holder in economics and statistics, master's degree in agribusiness management, and a bachelor's degree in agriculture. She was also a national athlete for Uganda in between 1998 and 2004. Warm hand clap for her as well. Then we have Mr. Wilbrod Humphreys Owor. Sometimes I tease him as the money man, to have him in a room and the deputy governor in the same room. He's executive director, Uganda Bankers Association, an umbrella body of Uganda's 25 commercial banks and 1 development bank. A businessman, bank executive, and management consultant in Uganda. He has served in different capacities. He was CEO of United Bank for Africa, head of retail banking at DFCU, head of channels at Barclays then, financial control at Sara Lee, East Africa, head of budget at Colgate Palmolive, East Africa. And finally, we shall have Dr. Thangavel Palanivel, is the chief strategist. We didn't have a hand clap for Mr. Wilbert Award. Dr. Thangavel Palanivel is the chief strategy and policy unit and senior economic advisor with UNDP. Prior to that, he was deputy director, Human Development Report Office, senior strategic advisor and chief economist for Asia and the Pacific, chief economist and chief regional strategy and policy unit, Asia Pacific Regional Poverty and MDGs program manager, and then a senior advisor, UNDP research fellow program manager, all within the UNDP ecosystem. A huge hand clap for him. And could the panelists please come and take up your seats? As they are coming in, some people have been in class. The panelists, please take your seats. Some people are literally in class. And these are students from Chira Secondary School, Namugongo. Please stand up for recognition. I saw some of you taking notes. I have to tell you, I'm a school principal, so I'm debating here whether I should check every note you have written down there, okay? There's Cimenta Alicia, Tukire, Joyce Pal, Lighton Nakungu, Mary Gift, Nanzi Richera Gloria, Tugonza Dorin, Atim Barbara, Nampija Daisy, Naika John, Mary Najengo, Kasango Davis. Is TV focusing on them? Hey. Let's have screens of them. John Oboth, Gloria Teduzu, Kawa Charles, Nanziga Julius Nakirai Robina. Yes, that's them. Segawa Shafik, Isaac Nigira, Mwila Kimanzi Bakita, Elizabeth Namialo, Anisha Naluvega, Ochora Brian, Katende Tony, Enoch Baliejusa. A huge hand clap for this class of Senior 5 and Senior 6 of Chira Secondary School. Real pleasure having them. Welcome to the panel. And each panelist has 7 minutes on their area responding to the paper. Can we begin with you, with Dr. Veronica Wabukwao, please?
Hello. Thank you very much. Again, thanks for the introduction. I have just 7 minutes, but I'll just start by introducing myself. I'm going to talk about operational efficiency at the public banks
And I'm also going to talk about the very crucial issue of fair lending. I have 7 minutes. So anyhow, I am Dr. Veronica, as I told you. I recently relocated from the United States back to Uganda. I think I'm making 2 years now, right at the beginning of COVID. I spent 17 years in the United States, and in those 17 years, I spent 13 years working in banking with HSBC, specialization in operational efficiency, credit risk, and I'm the consultant behind, we worked with many consultants and NPA behind the study that has been presented. So it's my pleasure to be here. I'm actually a bit intimidated, the number of MPs in here and everyone else. And they mentioned I'm a former national sprinter of Uganda. If you look for Vero, in 1998, I was actually the captain for the Commonwealth Games for Uganda. So the issue I'm going to talk about is operational efficiency. And before we start here, I would like to thank the public banks that are here with us and for the work that they're doing, because the public banks are really operating in a really challenging environment where they're undercapitalized, and fun enough, they've been able to remain profitable. In the last time we checked in 2020, all the public banks had actually been profitable, regardless of the fact that they have minimal contribution from the government, so kudos to them. What I'm going to talk about is what can we do operationally to improve performance at the public banks. There's a statement that was made by Mr. Sebukera, which I want to elaborate on a little bit because it explains everything that I'm going to say. Mr. Sebukera said that our Ugandan banks are applying prime lending models to manage credit risk in the subprime market, and I'm going to explain what that means before I proceed. Our public banks are very profitable, but the way they are doing business is not about the public, it's about the money. A public bank is supposed to serve the best interest of the public, and that's where this is all coming from. At the moment, everyone, the public banks, the private banks, everyone is doing the same thing. The profit is the focus is on profit maximization. We are giving products that people cannot afford. So let me just explain that sentence because it's very important. Prime lending. Prime lending means that you're lending to people who are good in their credit history. You're lending to people who pay back on time. You're lending to people who have money. You're lending to people who you don't even need to worry about that I gave you a loan and every time they just pay. That is a prime lending model. When you have a prime lending model, you are not good. Everyone will have collateral. Everyone will have a lot of money to pay back. Now that is a prime lending model. That is the model that public banks and every bank in Uganda is applying. This is all about prime. You need to have collateral. Do we have collateral in this country? Most of us don't. So pretty much the banks in Uganda are serving 20% of Uganda. The remaining 80% of Ugandans cannot be served, and we know the challenges, but those challenges doesn't mean that we can't lend. So subprime means you have people, maybe me, as the deputy governor said, people take loans and they don't want to pay back. That is subprime. When you're lending in a market where it's predominantly subprime like Uganda, we know Ugandans are not good at paying back money. It does not mean you cannot lend to those Ugandans, because it's your responsibility as a country and as banks to lend to a majority of Ugandans, not to lend to the very few. We have to find a way of making it work. As challenging as it is, we have opportunities we're going to be discussing about what we can do to change that. But in the meantime, it doesn't mean that the rest of Uganda should be excluded and we focus on the cream de la cream. So that explains prime and subprime. If you're subprime, you're a bad customer. I worked at HSBC, and funny enough, our strategy was lending to the bad customers. So we knew everything. When we sent you a letter and said, Dr. Veronica, I have a loan for you, it's because we have assessed everything and we know you're a bad borrower. So we are going to give you money because we know how to manage that loan. From the time you get into HSBC and you get a loan, we have attached a number to you and said, Dr. Veronica does not pay, so please, A, B, C, D is how you're going to manage that person. And that's what we're going to be talking about. So anyway, operation efficiency at the public banks, we have two different factors. When you look at operation efficiency, you really are looking at the best way, you're looking at production at the least possible cost. So our public banks have opportunities. Yes, they're profitable, but there's so many opportunities of making sure that we can lend in a socially economic way. Like I said, lend to at least more than 20%. Even the bad ones can borrow. And also make sure that we are maximizing profits at the same time. So I'm going to discuss three different areas. The first area of this is going to be about growing your new-to-bank customers. And the second area is going to be about how you minimize costs. Digital banking is a highlight of everything here. And then the third point is, of course, as we have talked about policy, it doesn't matter what the banks do. If the environment in which they are banking does not support them to reduce costs, then a lot of what's going to be done is not going to give us good results. So let's start with the first one, that is just getting new to bank customers. Look at a bank. When you look at a bank, we have a lot of fixed costs in the bank. You have the strong room, which is constructed for every branch, which is very expensive. You have the rent, you have all these factors that are coming in with you. And then you come and look at a public bank with just few customers, the good people. So if you have very high costs and you're only lending to very few people who you think are good, what are you going to do? Charge them very high interest rates. Because there are very few. I have a very small base, I'm going to increase my prices. What we are saying is, okay, expand your base, expanding your risk, but charge lower prices, but you're going to make more money over time through like a sales maximization model. So the difference is sales maximization versus profit maximization. So the examples that we have here for getting new to bank customers, like I said, the products that we are offering is like we're dangling a carrot at a dog. They are there, but no one can afford them. We don't have collateral. The average Ugandan doesn't have collateral, so what do you bring? Unsecured products, where you don't need collateral, or you're going to use chattels, which as a form of capital, of collateral. And how do you do that? Group lending has been very successful. Pride Bank is doing very well with group lending. So the product, and I understand Stanbic also has opened up an initiative where they're lending to circles. So this is the point. It doesn't mean I can't lend to the poor, but I can lend to the poor giving them products they can afford and giving them what is appropriate for them. So group lending is one, unsecured. I don't have collateral, you cannot give me a loan with collateral, so because you're going to exclude the majority in the country. We've talked about salary loans, which every Ugandan says that most people who bank say they're banking because they want somewhere to keep their salaries. Some of our public banks don't even have salary loans. Yet everyone who is going in the bank is because someone is paying me, so you're missing out on a lot of opportunities. We also need to talk about the quick loans, which is your money lenders. Money lenders have been able to penetrate this market, and they're doing very well because they've just gone to the simple factor that if you ask an average Ugandan is, if you need a loan, what is the main factor that makes you take up a loan? How quickly I can get it. We have talked about financial literacy. They don't even care about interest rates. So a money lender comes in and is doing exactly that. You want a loan, sit here, 50,000, that's it, this and that, and the loan goes. That is the opportunity that we have as public banks, but we need to give these loans ethically. We need to remember that we are not really going to encroach on the customers. So we need to find a way of, the way to get rid of money lenders is to offer similar products the money lenders are offering in a controlled environment and at more appropriate prices. This can be done, it's very common in the US. We have quick loans everywhere. You walk in, you put in your car, you come back, and then there's a lot of regulation around it that is not as encroaching as it is now. Now, that was the product side of it. I'm also going to talk about the financial...
Dr. Wabukwa, let me add 2 minutes.
2 minutes?
Yes.
Okay, if it's just 2 minutes, let me just talk, let me see which one. Financial literacy is very important. As the Deputy Governor has talked about it, most people don't know what they're borrowing. They don't know the interest rate, so that's an opportunity where we have for the public bank. On the cost side, we've talked about digital banking. Digital banking is the way, and our counterparts that worked with us on the financial management model actually have a full framework of how many banking agents the public banks need to have at any one point, and it's going to be about digital banking to reduce the costs. Now, before I go to the last one, I need to talk about fair lending in Uganda. This is very, very important. It's part of the policies that we've been talking about. I know now I have like 1.5 minutes to go, but I am running like nothing. So we have fair lending. I know I'm very fast. The things I'm talking about are really, really, really crucial that you might need to give me like some more time, because right now you're going to miss out on a lot of information. So what I'm talking about here is fair lending. What is fair lending? Fair lending means that when you're lending, every bank is responsible to make sure that they can lend in the environment that they operate in. We are all responsible to making sure that, corporate responsibility is part of fair lending. So fair lending means that if you're going to lend to a community, you need to lend in an ethical way that considers the well-being of those communities. I'll give you an example in the United States. The statement is you cannot discriminate based on income, you cannot discriminate based on gender, you cannot discriminate based on sex, household, whether someone has many children or not. That does not determine a loan. In Uganda right now, the fact that we are lending only based on income means that we are lending unfairly. And where does that come in? When you're going to lend to someone, there are two decisions. Should I lend to you or not? Decision number one. Decision number two, how much should I lend to you? Should I lend to you or not should not have anything to do with my income. It should do with my creditworthiness, which is what the Deputy Governor talked about. Creditworthiness is, are you willing to pay? It's not how rich I am, it's a behavior. Okay. And it's a behavior that credit bureaus are supposed to capture in their data to give to me.
Thank you, Dr. Veronica Obukwao.
Okay. Thank you.
Because we shall allow you a conclusion. The reason I gave you the extra 3 minutes was because my village mate, but a very powerful one, Mr. Michael Mugabe is here. He's the MD of Housing Finance Bank. There he is. So a huge hand clap for Mr. Mugabe. And he's listened to the fair lending, to the subprime, everything. So when we get to the village, I'll remind him all these things, of all these things. And as a bank MD, we want to see them happening. Let's go to the next big banker, Mr. Wilbrod Humphreys Owor, Executive Director, Uganda Bankers Association. Your 7 minutes start now.
Thank you very much. And thank you very much, NPA, for the session today. I want to straight away associate myself and the entire industry with the report. We did contribute to it and will continue to contribute to it. I also associate myself with the remarks that have been made by UNDP, by the PS, most obviously by the Deputy Governor, and they have made our work very, very easy. And so I'll focus really on how do we bring these things alive. A wonderful report. Of course, there are areas that need to be polished, but it is execution. And therefore, in my response, it will be threefold. One, around government, and this is about execution, about public sector financial institutions, and of course, the animal in the room, the cost of credit. The whole session today, and I think Julius made it easy for us, he said, speak the truth, help us speak the truth. It is, who is the biggest businessman in the country? It's government. Who is responsible for seeing these reforms and recommendations? Government. The actions that have been enumerated very ably today, government, and let me just break them down a little bit without repeating. We've discussed about non-performing loans. I think the DG said it very well. Government pay arrears so that businesses don't collapse, or indeed the institutions that lend them don't collapse or don't increase a margin to the cost of lending. Deliver projects on time so that productivity comes out. Have expenditure discipline. And this speaks to the government borrowing and domestic debt. Because the interest or loan pricing is anchored against the benchmark prices we lend to government. And because government has so much appetite, sometimes not necessarily utilizing the money in priority areas, if the discipline is there, automatically the benchmark rate comes down, isn't it? In 2008, for those who remember, President Kibaki then, may his soul rest in peace, in Kenya, took a decision that come and buy, we are going to minimize domestic borrowing. I will ask NPA to see what happened, study that case, and see what happened to interest rates in Kenya. So it takes seriousness in some of these policy measures, and they can happen. I think you can manage debt better, you can manage government cash flow better, you can execute projects well, you can put in place discipline so that those market imperfections are addressed. But also, when we write these things like NPA has a National Development Plan 3, Let's really speak to them and implement them. NDP3 has priority areas. And why am I saying this? Because it's not only banks to bring down the cost of lending. There are a combination of other things that help. And we are talking about the economy. NDP3 has priority areas: industrialization, tourism, ICT, skill-based agriculture, and so on. How much money do we put in as a budget, national budget, in these areas? You see, you say one thing on a plan, and the funding says something else. And these things translate themselves back into the cost of lending. And therefore, when we compared the other countries, the UNDP chief did, the report does about Kenya. Kenya's economy is $99 billion. Tanzania is 66. Uganda is 37. So we're actually poor. And therefore, when the report talks about dormants, nobody wants to keep an account dormant. It's because they don't have money to be in the account. That's the fundamental thing we will deal with, and we need to deal with. And therefore, coordinated responses, coherent government policies actually executed will ultimately inform loan pricing and availability of credit. Last year, we were privileged to sign in the Minister of Finance's boardroom something called Small Business Recovery Fund. I was there. We took photos with our chairman, the minister, and the deputy governor. 200 billion, isn't it? Government is putting 100, banks are putting in 100. Every month, unfortunately, I have the job of reporting to the DG how much of this has been disbursed. Since October, less than 3 billion. It is at 10%. It's not at 22% being quoted here. But the uptake is 3 billion. Yes, it is cheaper. But there are other fundamental challenges, including eligibility criteria, how to access the conditions and the criteria for qualifying for that money. And basic things like records, credit history, are putting out very many borrowers, even at 10%. So it tells you there's a lot more. I think the DG talked about the judiciary. These stories, and I will not talk about it because it is sub judice now, but you are aware of the recent stories in the media about financing from outside to support businesses here and the challenges there. Once that immediately happens, all the international co-lenders who work with banks have called and said, is this true? Is it happening? Are you really a good destination as a country? And yet we are looking for international financial flows. So these things, together with the judiciary, the policies to really make such behavior expensive and discourage, are important that we know about this market. Let me now go to public sector, financial institutions, and the cost of credit. The report is very clear, very good objective, 20% market share, diversify and lend to areas where private sector banks don't have the appetite, and bring down the lending by 5% or thereabout. Very good objectives, and we support them. Capitalize these banks by 2.5 trillion, very wonderful, because any bank's strength and capacity to bring down lending rates depends on its capital base. The larger, I'm sure you know, the lower the interest rates. In the banking sector, for those who may have seen the results last year, all the banks combined, 78% of their income comes from lending. Meaning we are so sensitive to lending that any adjustments, in fact, we had a session today with the governor. If we stress tested banks and their loans we restructured over the 2 years of COVID, if they deteriorated further by 25%, 7 banks will go under immediately. But the point I'm making is important to have a strong capital base, and therefore we support, if it is 2.5 trillion, which is a good number, The total capital of the industry, if you just take core capital only and retained earnings, is about 5 trillion. So the number you have put here of 2.5 is half that amount. If it is availed to those banks, it's a good thing. It will make them strong. I think it is how quickly government makes this available. We have previously said we shall capitalize UDB and it becomes a story in the budget. How quickly we do this, it will make a huge impact in the economy than many other sectors sometimes government money is spent in.
Thank you, Mr. Wilbrod Owor. I allowed you an extra 2 minutes.
Can I only have one, sir?
You have another one.
All right.
Okay.
So the other points I want to repeat, the need to de-risk, to focus on value chain financing, to incentivize. If we all implement these things, what is the incentive for the bank? Of course, governance, let's be careful that if government capitalizes them, they respect governance principle of running a bank. We have a history. We know why these banks were closed. We must not repeat them. The last point should have been the cost of credit, which has ably been spoken. And since I don't have an extra minute, I'll take it that we discussed it.
In fact, I allowed even the extra minute because Mr. Michael Mugabe was listening when you said the account is dormant because I have no money. I saw him nodding his head. I hope he has nodded. And then sometimes you bring the money, then he doesn't want you to open it. So, thank you. And then I just turn up to him, 3 billion of 200 billion. So I just go to him and say, let me go to the other account. That one I can give you a minute on that one.
Yes, there's low uptake. And I think we could have had challenge, which we are now revising. What's the criteria and the eligibility to get this money? Otherwise, it is locking out very many people. And as a result, they are not benefiting from what government intended. So that review is happening, and we will be adjusting the terms and conditions. Thank you.
A very worthwhile minute. Let's have a huge hand clap for our panelists. The next panelist is Dr. Thangavel Palanivel, the Chief Strategy and Policy Unit and Senior Economic Advisor with UNDP. Your 7 minutes begin now.
Thank you, moderator. Good afternoon to everyone. I also want to thank the National Planning Authority for giving this opportunity to UNDP and to me to share some of the international, perspective on this subject of the issue today. I wanted to actually say that, I also wanted to associate or agree with the recommendation presented in the paper, but my view with more closer to the Deputy Governor of the Bank of Uganda, like instead of government putting it actually on their own resources, they need to try to find some strategic investment and to strengthen, recapitalize that, because there is an increasing trend across the world to kind of, bring additional money to strengthen the public banks instead of putting its own money. So with that, but I was asked to speak 7 minutes on different topics, which is basically to ask me to present on options, intervention to enhance the financial inclusions, specifically to the youth, women, entrepreneurs groups. So that is the topics I'm going to speak 7 minutes. The access to the affordable finance, especially to the small, medium enterprises, especially to the youth and the women, is a challenge not only to this country, that's a challenge across the world. It's a challenge even for the developed country, I can tell you that. So therefore, using these 6-7 minutes, I wanted to highlight that what kind of intervention in those countries, whether it's developing countries, emerging economies in Asia, whether it is a Western country like Canada or United Kingdom, has done to promote the financial inclusions, to particularly focusing SME sector, also focusing the certain population group, focusing on women and youth. The first thing I wanted to highlight is that one of the widely used initiative is the so-called credit guarantee scheme, specifically to the credit guarantee scheme to the specific sector like agriculture, export, trade, and SMEs, and the youth women. And so that's actually, it's not something new. It's been there last 50, 60 years. There are many hundreds of successful story how that actually such a credit guarantee scheme actually helped to promote inclusive, development. I just wanted to, take some example there. Like why is a important intervention? Because such a credit guarantee scheme have a leverage effect. It's basically to encourage the commercial bank to provide actually more money to the SMEs and the youth and entrepreneurs. It has also a regulatory capital relief function. And finally, it has also a counter-cycle function. Like when crisis comes, whether it's a COVID, financial economic crisis, such a credit guarantee scheme help the micro enterprises. And as I said, in Asia, most of the miracle country, whether it's Japan, or South Korea, or Malaysia, Thailand, Indonesia, or even the new country like China, India, all had very comprehensive government-supported credit guarantee scheme. Like even 50 years back, Japan introduced 1970 a credit guarantee scheme for small medium enterprises, 100% guarantee. But after 10 years, there is actually, they reviewed the program, they found that there is a high moral hazard. Basically, when government guarantee 100%, then the bank is not serious enough to go collect the lending. So therefore, after 10 years, they reduced that actually, the credit guarantee to 70%. So many of the countries have, credit guarantee somewhere from 50% to 75%. So that's something that the country should consider that. As I said, Canada, UK is there. In Africa, also there are countries like Botswana has that, Tanzania has that, and Kenya has that. In Tanzania, it's focusing even the particular area, the Kilimanjaro, area, region. So they have specific actually credit guarantee scheme to promote the financial inclusions, focusing on youth, women-owned micro, small enterprises. So that's my first intervention I want to highlight from the international perspective. Very successful, intervention. The second one, many countries actually experimented with the so-called actually a regulatory measure, a policy measure, putting interest rate ceiling. Like basically the government or the central bank put certain ceiling to the commercial bank that you can actually give lending only this much. But again, the evaluation showed that it is not successful everywhere. Because it has some negative implication. It actually distort the markets, and it has distort the pricing signal. So therefore, many countries, experimented. Some countries, in fact, gone back. Like, for example, Kenya introduced 2016, after almost 10-year debate in the parliament, 2016 introduced the kind of ceiling, credit scaling, but in 2019, they withdrawn that. Still, South Africa, some country like Zambia and all has that in this region. So therefore, my suggestion is that instead of going to that kind of, not proven successful initiative, should consider an alternative measure. The alternative measure is that, many countries actually, set up some certain percentage of private credit to the small, medium enterprises or youth-owned. Particularly they say that 1/3 of the commercial bank credit to the private sector should be given to the micro, small enterprises owned by the youth, women. 1/3, 1/4, or 50%, something like that. So setting up a kind of certain percentage of the commercial bank credit to the focused, sector or population group, again with some kind of ceiling of interest rate would be alternative measure. The second one, regulatory policy option is that consider that the introduce taxation of windfall taxation against on the excessive bank profit. In this country, like the Bank of Uganda study highlighted that the commercial bank tend to give to their depositor, their customer, only 6 to 7% as the rate, as a deposit rate. But the people who invest in the commercial bank, they get annual return of 16%. So 16% of on return on bank equity is a very high compared to what the banks pays to their own customer. Most of the customer is all middle class people. So therefore, maybe you may consider possibility of introducing a tax on a windfall actually on the profit. If the bank has such excessive profit, then maybe government could try to take at least some of the profit. So that would discourage the bank going to the excess profit, try to reduce the cost of credit. So that's my second one.
Oh, thank you. I was just saying thank you, because we've really run out of time.
Okay.
I only wanted to ask, are these things possible?
No,
and
maybe
I'll
I
ask
stop.
you at the end when we have a
Sure, I stop
on the
that.
plenary. Yes.
Thank you.
And finally, of the panelists, Master, Mr. William Byandu, sir, a businessman and the managing director, Master Woodworks Limited.
Good evening, ladies and gentlemen. Protocol observed. As already introduced, I'm professionally a teacher. I taught from 1977 to 1983. And in 83, things became difficult. I joined business. I'm the director, the MD, Master Woodworks, which deals in furniture production, Master Wood Investments, which deals in residential and commercial real estate, and Master Supermarket. So the issue of borrowing is an everyday nightmare to me, because I have to borrow to survive. I have been invited to participate as a discussant, as you all know, in reducing the costs, lending costs in Uganda. It's mentioned that it is going to be discussed by a panel of experts. I wish to state that I fit better, of experts and audience, I wish to state better that I fit better in the audience, because I have never been an expert in this particular field. With that in mind, I have been specifically asked to focus on challenges in accessing credit. And I think whoever decided that thought it well, because every day I'm running in the corridors of the banks trying to access credit, and I have my experiences. I will not limit myself to the public banks, but also to the private banks, because their intentions, as of now, appear to be the same. As already mentioned, Mr. Mugabe is over here in the audience, but I understand. All I know that his prime lending rate is not any better, or not far better than the other private banks. So the challenges are the same when you are borrowing. So many speakers have talked about the cost of credit. The cost of credit has a direct influence on the challenges of borrowing. Borrowing is a very expensive venture in Uganda, as you all know. The current rate is at 22%. With the biggest bank, public bank, of my friend Mr. Mugabe, being round about 20%, which is far higher than most other private banks in the neighboring countries. I know the UNDP representative has talked about it, and several others have talked about it, but I would wish to probably give you an overview of what other countries are lending at. Our Ugandan lending rates, as of 2021, this data can be got from Google or at data.worldbank.org. Uganda in 2021 was at 19.8, Rwanda at 16.2, South Sudan at 16.1, Tanzania 13.8, Burundi 12.6, Kenya 12.17, Zambia 9.5, Seychelles 9.2, India 8.8. I am bringing in some of these far countries for the benefit of you, understanding that we businessmen are competing with the people coming from those far countries who may have borrowed at better interest rates and are therefore challenged to effectively compete with them when we are doing business. South Africa is at 7, United States at 3.3, China 2.85, United Kingdom at 2, Italy at 2, Germany at 1.78. These are 2021 figures. I am sure they haven't changed much. Now, not only is the lending rate very high, there are also very high incidental costs in borrowing in Uganda, and those pose challenges to whoever intends to borrow, because he has to think twice and see whether he's going to make it. For instance, you have to get project proposal fees, you have to get approval fees, you have to look for valuation fees, insurance fees, legal fees, statutory fees, and loan supervision fees. All these are costs added onto this high lending rate. How is the Ugandan going to compete with someone who borrowed from China and was facilitated by his government to come and do business in Uganda, and he borrowed at 2.8, and you are borrowing at 22%. Do you really see the intensity, the challenge? Oftentimes I've heard our leaders, I hope not our ministers and our MPs, but I've heard our leaders say that we are very lazy, we are not serious, we are spendthrifts. How do you bring to terms this disparity between 22 and 2%? You must praise us, we businessmen, for being hard workers. The second challenge that is faced by the Ugandan borrower is collateral or security in simple terms. Most businesses lack the requisite collateral to mortgage to the credit institutions. As you've already heard, studies have said that only 20% have collateral. So 80% don't have collateral and don't fit within the bracket of borrowing. It becomes worse. It becomes worse when it comes to women and youth, because oftentimes you know our culture. The little collateral, the house that is there is probably in the man's name. The woman may not have anything to go and place before Wilbrod's institution because he doesn't have collateral. And the youth who every day we say we should, what's the program on now? To skill these youth. We skill them, true. But when they come out, what do? They don't have anything. They don't have money. They've not been employed. How can they put their skills to use when they don't have the starting capital?
Mr. Byandusa, allow me to interrupt you for just 1 minute. I'd like to recognize Honorable Dennis Nyangweso. He's also here. Can he stand up for a wave? Thank you very much. We have Mrs. Goreti Masade, CEO of the Uganda Institute of Banking and Financial Services. Thank you very much. Could we have a huge round of applause for our panel as Honorable Rugolobi comes up and closes this conversation officially. But as he comes along, I'll tell you, also have Mr. Alan Senyondwa, Private Sector Foundation, Uganda. Honorable Rugolobi, if we could just close the conversation.
Thank you so much. We shall beg your indulgence. This has been an imposed closure, but just wait for the reality. You don't have to be so worried. But first of all, I want to thank so much you, the participants, for coming to attend this very important conversation. Thank you so much for coming. And I want to thank the panelists, the presenters who have come from various corners. I think this has been such a powerful engagement, and we believe that we have benefited quite a lot as a country. As Minister of Finance, we are going to make sure that we implement the recommendations that have emerged out of this interaction. Thank you so much for coming to attend this very wonderful workshop. Thank you. And may I now declare the workshop closed.
That's the power Honorable Ugolobi has. Thank you so much, our viewers on NBS TV. We shall continue discussion in the main hall here. Most welcome to Honorable Dr. Chris Baryomunsi, who is representing the Prime Minister. Honorable Baryomunsi, please come and take up your seat here. As he's coming along, I'll tell you about how TV works. And we've been on NBS TV from 2 p.m. to 5 p.m. exact. So sometimes, even for TV, you create the drama, but as Honorable Ugolobi says, the reality is going to continue. So let's give ourselves a hand clap for even managing this drama. Yes. And now we continue without television. So, Mr. Vyandyusa, just wait a bit. Honorable Baryomunsi, please come and take your seat.
Thanks, Bwana Moderator. I thought you had found my views very useless and therefore closed.
No. In fact, I'd already given you 2 extra minutes because of when you talked about the pain of private sector. Even at this midpoint, let's give him a hand clap.
Yeah, just continue. There is a lot of reluctance to finance rural projects. It's a big challenge if you are involved in a rural project. It has already been mentioned by several speakers, but I wish to add on my voice to that. Credit offering institutions are very reluctant to finance agriculture, forestry, ventures, and even tourism at times. Agriculture is the backbone of the economy, and forestry is not only viable, but is also important for mitigating climate change. It's very unfortunate that these ventures cannot be easily financed. Probably, if Mr. Honorable Minister Ugolobi can throw his weight behind and promote the public banks, they probably would go there more than the private banks. More than 75%, as you all know, of our population are engaged in rural agriculture. And rural agriculture is not done in Kampala city, nor in Jinja city. It is done in the rural areas, and their financiers are not willing. I wish the recommendation mentioned by my fellow discussant could be taken on. Government guaranteeing schemes. This could go a long way to assist the women, the youth, and the people in the rural areas if they are guaranteed by this particular scheme. Of course, the issue of well-financed banking institutions need not be emphasized, and for the benefit or for not being having a lot of time, let me jump that. There is the issue of poor sensitization as a challenge, people accessing public credit. I think some speakers have hinted on it, but please, the government is implored to take deliberate measures to educate the people the benefits of going into proper credit banking institutions, because otherwise we are being murdered by the money borrowers, because we don't know. As was mentioned, someone comes up, I think it was mentioned by the ED or someone. If he says, the money lender says, I'm lending you at 10% per month, and the bank is giving you at 18%, because these people are ignorant. They have not been sensitized. They think the bank rate is much higher, yet it is not. They are being fleeced. So government should have a deliberate effort to go and sensitize or have programs on radio and TV and educate people the advantages in using proper regulated credit institutions. Competition for credit by government from local credit markets. This need not be emphasized by me. Basically, every speaker has said it. This is a very, very big challenge to the private borrowers. The public, this disadvantages the private credit seekers and hikes the lending rates. Because if someone is sure that government is going to borrow from him through treasury bills at 12% or 14% at times, why should he give Masterwood at skin or 18% when he's going to be chasing Masterwood? He'd rather put his bank into treasury bills, go and relax. Purchase of treasury bills and bonds is a risk-free, lazy way of making profits that is so attractive to the credit institutions at the detriment of private borrowers. So government, we beg you, MPs, we beg you. I heard the PSST say that they have already resolved to lower. I take it with a pinch of salt, because only 1 week, my honorable MPs here passed a supplementary budget, and in that supplementary budget, I heard that there is a lot of local borrowing. So today, if I go to Wilbrod, they may say, no, I'm positioning myself for the intending borrowing by the government that is on the way.
Okay. Thank you, thank you.
In conclusion, let me conclude just 1 minute.
Okay.
While challenges to accessing credit by the private sector are many, two major interventions by government can go a long way to alleviate these challenges. One, more funding for existing public banks, whose goals should be targeted to national development rather than profit maximization, as is done by the private banks. The second is government should end, or at least reduce its appetite for borrowing from local commercial banks, which always leads to hiking their lending rates to the more risky and more expensive supervised private sector. Yet the private sector is the engine to national growth. You people in government, allow me, I'm not very diplomatic, I'm a businessman. My language is money. You people, why don't you leave these borrowing institutions here for us and go for international borrowing so that our rates can be mitigated? Thank you very much.
Thank you very much. Let's have a large round of applause for our panelists. Dr. Chris Baramunsi, Honorable, is here, representing the Prime Minister. We had Dr. Veronica Wabukao, who promoted fair lending. She promoted that even us bad borrowers should borrow. We loved it very much. We had Mr. Wilfred Wilbrod Owo. He said, yes, government should inject that 2.5 trillion because they will have capacity. Dr. Thangavel Palinavel, he has some really good ideas about the share in banks according to percentages and what other countries are doing. And Mr. Byandyusa has given a good case for us who work in the private sector. You need to appreciate us some more. We are suffering and competing with people coming with capital that is not expensive. The Minister of State for Finance also tasked NPA to do yet another study on where to find money. and the Deputy Governor, Bank of Uganda, is also thinking it might not be such a bad thing, but maybe we need to look at strategic investors into banks. We are kind of out of time, but we can allow 4 people from the audience here, and then the Dr. Baromosi will close on behalf of the Prime Minister. So as a practicing teacher, I only look at the people at the front, and I've seen them already. So that's 1, 2, 3, 4. Mrs. Chigongo. Let's have a microphone.
Okay, thank you very much. Allow me to thank NPF for this report, and also the speakers and presenters who have spoken. But I must express my disappointment that when the committee was being formed, private sector wasn't brought on board. So, Dr. Pamela, please, and I hope that we can be given opportunity to give our views from private sector. Master Wood has just actually spoken about private sector on what we are going through. And I hope, Ariaron was actually chatting with Charles here, what has been talked about, we've had it before, with due respect. We've had these conversations before, to do with the government borrowing, to do with the high interests. My question is, or my humble request is, I heard Honorable Guru saying that they have had recommendations and they are going to implement. Honorable Gurubi, I hope these are going to be implemented. The reduction of the interests, capitalization of the public banks, we are for it, but there's one thing that has not been mentioned. There's also political interference in these public banks. So when you capitalize these banks, will you make sure there's no political interference? Will you make sure that we are told to speak honestly? And I'm speaking on a constituency that is going through a very hard time, and this is the private sector. So we support the capitalization, we support the reduction, we support all the recommendations, but please, political interference, I didn't hear it and I want to emphasize it, and of course corruption. The other issue I want to talk about is the women and the youth, which was articulated by the gentleman, the tech advisor to UNDP. What I want to tell you is that when you lend money to a woman, be assured that will pay. Women are very good at paying their, we're more honest. No. Of course there are those who default. What I'm saying, if you had to compare, the women would pay. So in all these, we have a window for the women in particular and the youth in these private banks. Okay. I thank you very much.
Thank you. Just move the microphone on. You don't need to switch it off. Just move it on to the next panel. And yes, go on as the microphone moves.
Thank you very much, Right Honorable Prime Minister.
Just wait a bit.
Thank you so much, moderator.
One second. Just wait a little bit. Just hold on, and then you'll finish.
Right Honorable Prime Minister, Bank of Uganda has done very well. The CBR, Central Bank rate, moved from about 12% to now 6.5%, expecting that this would pull down financial institutions to bring down the interest rates. This has not happened. Wilbrod has just stated that the issue of bringing the lending rate does not only rely with the banks. It involves everybody, starting with you, Right Honorable Prime Minister. If we can increase on the revenue collection to GDP so that we can address the issue of the fiscal deficit, and therefore will be able to reduce, first of all, on the external borrowing, but in particular, the domestic borrowing, which is now crowding out the private sector. Two, a lot has been said about agriculture. Big agriculture is getting what is being called agricultural insurance. The small farmer in the village does not require this. All that they require for the banks to be able to lend to agriculture, to the small agriculture, is just water for production. If you give them water for production, banks will be enticed and encouraged to go and lend, because most of the failures in agriculture is not coming out of armyworms. It is coming out of failure to get water, the rain-fed agriculture. So give them water for production, and you will see the number of banks that will rush to go and lend to agriculture.
Thank you, thank you.
Now,
Thank
as
you
they
very
do
much.
that,
As
they do that, right or up.
Thank you, thank you.
I'm just winding up.
No, don't, let's keep, you've made the point.
Okay,
Thank you.
I'm making the last one.
We have a gentleman here. Yes.
Just one more.
Thank you, Mr.
Thank you.
Moderator.
Thank you.
My name is Taiwo Herbert once again. I want to take the opportunity to thank National Planning Authority for this researched information which we have got. And I also want to believe that government must invest in public banks purposely for national development, but not for profit maximization. For example, I was reading Stanbic Bank posted profits after tax in 2020, 242 billion, in 2021, 269 billion, and half year 2022, 154.9 billion. And this is simply because of the high interest rate. However, having said that, I'm one of those who don't believe that credit financing is responsible for development or wealth accumulation. And where am I coming from? To accumulate wealth, you must make sure that your expenditure is always below your income. Actually, the saying goes that if you spend more than you earn, or if your expenditure is above your income, you will never accumulate wealth unless if you steal. So, what are we saying? We have seen people who have grown organically, both at individual level and company level. When they have grown organically and had some accumulated wealth, that's when the banks start calling them. That's when they attract the banks. Now, when they attract the banks and go and get loans in Uganda at this interest rate, you cannot pay the loan with that high interest and accumulate more wealth to add on what you have. Many of them have survived and remained stagnant, and many of them have actually failed, and the banks go ahead to sell their properties. So my wish as a leader, and actually request other leaders, that we should be encouraging our people to save and grow organically through saving and investment other than running for banks. But for the government of Uganda to put money in public banks purposely for national development, I agree with it. I thank you.
Thank you very much.
Thank you so much. And thanks NDPF really for this information. 2 points.
Julius, introduce yourself.
My name is Julius Mukunda, and I'm the Executive Director for the Civil Society Budget Advocacy Group, CSBAG. I think the fight we had last time about the interest caps, that was actually the right time to have this particular discussion. Because I think something which you have said, that even when we have reduced interest rates with the small and medium enterprise fund, accessibility is still a problem. So what guarantee are we having that even by providing this money to these banks that we want to create, that people will actually access this money. So there is a whole huge point of understanding accessibility to credit. How can you qualify to be able to access that money? The second point, and the last one,
if it is very quick,
is let us not shy away. Ugandans are very, very, very afraid of government getting itself into business. Because our CV as a government, we are very, very bad at making business decisions. We need to address that first before anything else. Thank you.
Thank you. I've allowed one more question from my constituency. They had sent me away from the table.
Yes, now you will come back. Thank you very much.
2 minutes. Introduce yourself. Yes. And
my name is Richard Sewachiriang. I'm a senior research fellow at the Center for Basic Research. And this question really goes to Veronica, Dr. Veronica Wapua. I think because I really want to understand, because I feel there is a contradiction in terms of the conclusion you make in these studies and the observations that the findings. And for me, you keep saying that we should not consolidate the 3 public banks. But I feel that the logical thing to do for Uganda is to have one big bank, let it be able to create the different facilities, take advantages of the economies of scale, and then that one big bank, we work on the issues of governance for it, and then we put it on the stock exchange, and we mobilize the 2.5 trillion, instead of thinking that there are people out there who will give us 2.5 trillion when we are marketing ourselves negatively, the way we have talked about with all these cases. So I feel that probably this is the logical conclusion from your findings. But it looks like maybe because you had the banks on the study, that it was a case of the monkey in the jungle. So, but tell me if this is
Thank you.
A logical conclusion.
Thank you, thank you. Dr. Thangavel, I'll allow you 1 minute to respond to Mrs. Chigongo, if you have a response.
Yes, it's going to be a quick...
No, hold on. Let's first get, because did you note the question she asked? No. You didn't note maybe... I
have the answer.
You have the answer as well to that one?
I have the answer to his question.
Yes. Go on.
Okay.
A minute.
So, and I'll be very quick. So there are a couple of things you need to consider when you're going to merge any businesses. The first thing you need to know is, are the systems the same? So we did a lot of work in the background, and we looked at the systems that as Housing Finance has, the systems that Postbank has, and the system that Pride Bank has. And if you look at them, they are completely different, that you're going to spend over 5 years just trying to figure out which goes where when you start merging. Also, one of the things that came out here with why we believe the banks should be different is, as everyone has told you, these guys have spent a lot of time specializing in a given niche that we usually have to do. It has to be a benefit cost analysis. And when that was done, the cost of actually merging these banks were really much higher than the benefits that you would get from it.
Thank you very much. Mrs. Chigongo, the one question to Dr. Thangavel, Palanivel.
Yeah, he mentioned something to do with the women and youth credit, I think government
percentages, yes.
Percentages. So my question is actually goes to the Minister of Finance and the central bank. Is there something that they're going to consider in these new recommendations? 2, the other one was, are we going to do business differently from what we've been talking about? Thank you.
So do you think the ministry can do that?
Yes, as I said, there is 2 important actually options if country wanted to consider from international best practices is basically, I mean, at least guaranteeing a part of the credit loan to the SMEs, youth, women, so that actually the commercial bank take actually, I mean, the accepted risk and provide a loan. That's the first one. The second one, what I said that at least also government should actually establish some kind of a kind of quota, a percentage of the commercial bank credit to the women and youth and the SMEs, which is the many country has been doing. So the country should actually consider here also. So that's, I would actually again say again that that's the way you could promote actually the inclusive development, bring more youth and women-owned micro enterprises, small medium enterprises into the overall private sector development and accelerate growth and development.
Okay.
Thank you.
Thank you very much. Ladies and gentlemen, allow me now to invite Honorable Dr. Chris Baryomunsi, who is also representing the Right Honorable Prime Minister, to give remarks and realistically close the conversation.
Thank you very much, Oscar. My colleague, the Minister of State for Finance, in charge of planning, the Honorable Amos Rugorobi, and members of the high table, who include the Deputy Governor, Bank of Uganda, the Executive Director, NPA, Professor Pamela, the resident representative UNDP, the honorable members of Parliament who are here, the heads of various government ministries, departments, and agencies, our distinguished panelists who are here, the other government officials, the officials from the banking institutions who are present, ladies and gentlemen in your various capacities. When I was entering, the Honorable Amos Rugorobi declared the meeting closed. And I thought I had turned into a pathologist, because in the medical profession, a pathologist usually arrives 1 minute late when the patient has already died. But I was advised that he was closing for purposes of the television. Now me, I will close for purposes of the participants here. So both closures are correct. My name is Chris Baryomunsi. I am standing in for the Right Honorable Prime Minister of Uganda, Robin Nabanja, who is not in Kampala, outside Kampala on official assignment. But substantively, I'm the minister responsible for information, communications technology, and national guidance. So every time I interact with the people, I am duty bound to guide them. Now I have short remarks from the Prime Minister, which are written. I will not take long. But before I read the specific remarks, let me start by thanking the organizers, National Planning Authority, UNDP, Ministry of Finance, Bank of Uganda, the team that put this arrangement together for a very wonderful meeting this afternoon. I am sure all of us who have come and participated, we shall not go back the same in terms of appreciating issues to do with the banking, the credit systems, and all the key issues which have been discussed this afternoon. So I want to thank you, the organizers, the people behind this discussion, and also appreciate the presenters, the discussants, the panelists for your time and also the intellectual disposition that you have given us this afternoon. I would like to thank the partners in the banking industry, if I can call it industry, for the good work that you are doing, because I think over time, the banking sector has grown and continued to grow. And the penetration in terms of the infrastructure, I think, has improved, because when you drive in the countryside, you get branches for most of the banks. Stanbic, Post Bank, Centenary, many of the banks, the commercial banks, you find them deep in the rural areas, meaning that the distance that the population travels to reach the banking infrastructure has considerably come down. Maybe you have better figures, I'm not sure, in terms of penetration as to the clients, the growth of the people that use banking services. But I'm also certain it has been increasing, because when I was growing up in my village, people used to keep money in the pots, calabashes, and cow horns, because that's the safest and the most easily available technology they could use. But now banks have become increasingly available. But I just want to add that we are in a period when there is a revolution in the technology. And that presents positive aspects, but also it presents challenges to the banking sector. So I want to challenge you, people in banking, to reflect on how this fourth industrial revolution, the evolution in technology, is going to affect banking. Like now, the competition between having money in the banks and keeping the money on these supercomputers. Issues of financial technology. I am sure you are well versed with all of this. As a minister responsible for communication technology, I see that we need to study a lot and see how these disruptive technologies are going to affect, or they continue to affect, the banking industry. I recall when there was a discussion on blockchain technologies and cryptocurrencies, there was a divided opinion even from you, the experts, because these technologies are new, they are coming, they are disruptive, and therefore we have to reflect on how these technologies, which are moving very fast, affect either positively or negatively the banking sector. I also want to assure you, the audience, that the government is here, the minister has been here, Bank of Uganda is here, NPA, and many officials, and we take the recommendations from these kind of discussions extremely seriously. So Professor Pamela, I hope there was a team that was capturing the recommendations, so that as government, we see how to integrate all these beautiful recommendations into the work of government. I heard my sister there talking of government interference. Sometimes people confuse government interference and government intervention. Sometimes government may intervene, not necessarily interfering. But the point I am making is that we take in good faith all the suggestions, all the recommendations, and we should be able to pick lessons from this kind of discussion to improve the way we do things as government. I therefore want to thank you for all the contributions that you have made this afternoon as you discuss this important subject. Let me turn to the brief remarks written by the Prime Minister. So when I say it is my pleasure, it is the Prime Minister's pleasure. But I cannot depart from that pleasure, so I also take that pleasure. So ladies and gentlemen, it is my pleasure and joy. So the Prime Minister has joy, I equally have joy. To join you for this National Development Policy Forum to deliberate on strategies for reducing the cost of credit in Uganda. I wish to commend my colleague, the Minister of State, Finance, in charge of planning, the NPA chairperson, those who are here, and your technical teams for this thematic study aimed at guiding the government on the best option for public investment in the banking sector. The NRM government recognizes the importance of the banking sector in the achievement of the NRM Party Manifesto. the third National Development Plan, NDP3, and subsequently the Uganda Vision 2040. Access to financial services can help poor people raise their incomes, accumulate savings, and better cope with shocks to their income, thereby enhancing their welfare. In this regard, effective participation of the public sector in banking is extremely critical. Distinguished participants, according to the Uganda National Household Survey 2019-20, 43% of the Ugandan population has no access to either formal or informal financial services, despite the various government interventions as 1, reducing population risk through implementation of the National Identification System, 2, development banking through capitalization of the Uganda Development Bank to provide affordable lending rates for the SMEs, 3, microfinance support initiatives such as the capitalization of the Microfinance Support Center, EMYOGA, social assistance grant for the elderly, SAGE, as well as youth and women funds, among others. In other words, government has provided a plethora of funds to facilitate the population to be part of that financial inclusion, but 43% of the Ugandan population has no access to either formal or informal financial services. And that's a very important point for all of us to note. Lack of access to finance is one of the biggest obstacles affecting the growth and sustainability of micro, small, and medium enterprises, MSMEs. In the Uganda Micro, Small, and Medium Enterprises Policy of 2015, it was noted that one of the major constraints of the MSMEs was limited access to affordable finance, and where financial products existed, interest rates charged were very high and unaffordable for majority of these enterprises. And this is the point which we are discussing toward the end of this meeting. In trying to access loans and other credit facilities, financial institutions often require immovable assets like land and buildings as collateral, leaving out those who own equally valuable movable assets. However, the government has launched the security interest in movable property registry system, abbreviated as SIMPLE, backed by the Security Interest in Movable Property Act of 2019 to facilitate access to affordable credit using movable assets such as intellectual property, farm produce, livestock inventory, vehicles, equipment, and account receivables as collateral. SIMPLE, which is Security Interest in Movable Property, is a web-based registry which contains registered security interests in the movable assets. Registration is done by authorized creditors like banks, microfinance institutions, circles, and money lenders, or their representatives, and the information entered is available to the general public for searches using the prescribed criteria. But let me add my own words to say, Honorable Minister of Finance, I think people still find it difficult to access the funds that we provide. If I can speak as an MP, without deviating from the speech, we recently provided money, I think 100 billion, to be matched by 100 billion by the commercial banks for the post-COVID relief. But in my constituency, I tried to help people who were affected by COVID, but they have found the process very challenging. They can hardly access these resources. There is a need to refine the procedures and how these local people can access these funds. So it's a challenge. We do provide these resources, but sometimes the procedure becomes complicated for the local people to access some of these relief funds. That's my only comment as a member of parliament from the experience I have just registered in my constituency. And I thought I should raise it because this is the discussion we are having. How do we facilitate our people to access banking services, including credit? Ladies and gentlemen, I am glad that the study by the National Planning Authority has pointed out some concrete actions to reduce the high cost of credit through public investment in banking. The government is committed to carrying out further reforms in the banking sector. Through the parish development model, the government is emphasizing financial inclusion, which is the third pillar, as you all know, by investing 17 million Uganda shillings for each parish as a revolving fund, and this revolving fund will be channeled directly from the treasury to the beneficial accounts that will be opened in the regulated financial institutions to ensure that households in the parish are able to save, borrow, and invest. Maybe to add more point that the 17 million has been released in this current financial year. And right now, data is being collected at the village level, and the population is being supported to form circles at the parish level, and the money, the 17 million, is already with the districts, and it will be deposited on the accounts of these circles in all the parishes. And like the government has been announcing, we have made a provision that starting next financial year, which is around the corner, then each of these parish circles will be credited with 100 million shillings. And the money will be sent directly from the center to the parish circles, not through intermediary steps like districts or sub-counties. So the money will directly go to the beneficiaries in a circle that belongs to the community at the parish level. And hopefully this will address the other 43% where we shall have majority of Ugandans included in the financial sector and the money economy. In the financial year 2021-22, the parish revolving fund interest rate shall be 6% to cater for the cost of inflation and the cost of implementation of the parish revolving fund. And the maximum duration for recovery of funds is 3 years. And we want to further caution Ugandans out there that this is a revolving fund, not an ex gratia payment to Ugandans, because people have a habit of thinking because we voted NRM has now rewarded us and sent us the 100 million, so we share it. No, it's a revolving fund which people should borrow because it's affordable, it's cheap, and then they should be able to pay back so that many more people can benefit from these resources. It's important that we emphasize this, especially to the other audience out there, the beneficiary population in the countryside. Further, government is actively working to address some major restrictions to credit availability. UDB has been recapitalized to the tune of 1 trillion Uganda shillings in order to establish more accommodating conditions on cost of credit, collateral requirements, and streamlined loan processing. As I conclude, ladies and gentlemen, we have to continue to pursue progressive and inclusive approaches to increase access to affordable financing for all. And this will allow our industries to develop, increase the productive capacity, which will further improve the overall quality of life. I want to once again take the opportunity to thank all of you who have spared your time to come and participate in this important discussion this afternoon. And I want to reiterate that as government, we take the recommendations and the suggestions generated from this discussion extremely seriously, and we shall definitely integrate them in the planning and budgeting processes of government to ensure that we continue to improve the efficiency and performance of the banking sector in this country. With those remarks, I want to take the pleasure and opportunity to declare the 11th National Development Policy Forum closed. You can therefore leave at your own leisure and pleasure. Thank you very much. May God bless all of you. So I don't know whether I go back to the panel sitting or the other sitting.
You choose.
Where do you want?
Prime Ministers choose. Maybe over there.
Over there. Okay. Thank you very much.
Thank you very much, Dr. Baryomunsi. A huge hand clap for him, for his remarks, and Right Honourable Prime Minister's remarks as well. I'd like to tell the audience that I had power to choose where he can sit next, just for a few minutes. Yes. Thank you very much, our panelists of the session, in the conversations. Thank you very much. People have commented from the television viewing. Thank you for all the advice you've given. Thank you, keynote speaker, Dr. Joseph Muvala. Thank you, Honorable Rugorobi. Thank you, Deputy Governor. Thank you, Dr. Chris Baryomunsi. Thank you, NPA. We've come to an end of the end of our session, and I'd like us to play the anthems. And could we rise for the anthems? And just before we do that, I will invite you to do one remaining thing, is to have a huge round of applause for me, Oscar Semoya Msoke. Thank you very much. Anthems, please.